Japan just around the corner, BOJ tomorrow. This time next week, it's the BOE. This is a story that we've been talking about here at Bloomberg. Advisors to the Chancellor of the Exchequer, Jeremy Hunt, worrying that the Bank of England risks raising interest rates too much and potentially pushing the economy into recession. I was going through the body of the story, Bramo, and there's this worry. They appear to be worrying that the central bank will feel public pressure to continue tightening because they were so late to begin when they started this hiking cycle back in December 2021, which would force them maybe to go too far.
It highlights to me how different people become when they shift from a policy role to a political role, right? I mean, this is something we have seen in the U.S. as well, where in the political role, you're more concerned about recession. That's the preeminent concern. And when you're on the committee, it's inflation. And that is the bias in either direction. At this point, their concern could be said around the world. But again, it's the emphasis around the political versus the monetary policymaker.
I should share the statement from the Treasury that the Economic Advisory Council provides independent expert advice on economic policy to help grow the economy. Their views do not reflect the views of the government. This last line here, monetary policy is the responsibility of the Independent Monetary Policy Committee at the Bank of England. I mean, I'm just saying that, you know, sometimes it might be beneficial if you have this board of economic advisors that do that work for you, sort of, you know, through the back door. Yeah,
well, I mean, look, you could say that I'm wrong and that it's not politically motivated, but other people might suggest that your view does get slightly shifted when you are advising a political player.
Whether it is or it isn't, if the optics start to lean in that direction, I believe that's problematic.
That's going to be a big issue in the U.S. as well, the independence of a central bank at a time when there isn't a lot of data, there isn't a lot of clarity in terms of where inflation is going next.
Bank of England this time next week, ECB just around the corner. We need to talk about some single names. Meta in the pre-market, absolutely flying, climbing after reporting revenue and a forecast that beat estimates. The stock is up by almost 9% right now. The social networking giant betting on this thing called Reels, a short-form video series that completes with what users see on TikTok to draw attention to Facebook and Instagram. I'm looking forward to this conversation a little bit later on Bloomberg Technology at 12:30 Eastern Time. An interview with Susan Lee, the Meta CFO. That conversation, Lisa, just around the corner. This stock performed tremendously well year to date, and we had some more weight to that this morning.
Meta has done a great job of copying successful social media platforms. Right. I mean, essentially, that is what we have seen consistently, whether it's TikTok or whether now it's the company formerly known as Twitter, which I cannot continue to say, but I'm not going to call it X. I'm sorry, I cannot do it. I just can't bring myself to that.
The problem with X is that no one knows what you're talking about still.
I mean, honestly, this is the artist formerly known as Prince. It's basically the same thing. So anyway, I am looking forward to understanding whether people really do lean into this, hold their nose and buy, even after the rally that we've seen, given the performance that we've seen so consistently with the big tech names.
Stock up by close to 9%. Phenomenal performance. Concerning performance yesterday on Capitol Hill. Senate Minority Leader Mitch McConnell abruptly stopped speaking and froze in place for what felt like something like 20 seconds at a news conference, a briefing with reporters. There are real concerns about the 81-year-old's health. Hours later, the senator spoke to reporters, tried to reassure them a little bit, Lisa, with this quote. We talked about this earlier. The president called to check up on me, and I told him I got sandbagged, which I assume is a bit of humor, alluding to what happened to the president when he tripped up a month or so ago.
Look, we all feel for Mitch McConnell. That is an embarrassing moment and one that really does raise questions about his health. And you heard that in comments, even from the other side of the aisle, whether it's Chuck Schumer or others. They want to make sure he's okay. But underneath those comments is a question about honestly assessing health at advanced ages at a time when, as we were talking about just moments ago, the U.S. representative body is getting a lot older.
And the rest of the world seems to be going in a different direction. You know, I thought Tom might be here and he'd ask the obvious question, is it like this in the UK? And I was going to have the numbers ready for him.
Well,
average age of Parliament, something like 50.
Yeah.
And in the United States, in the Senate, it's the 60s and going in the wrong direction and getting higher. It's in the mid-60s or something like that. Rishi Sunak's in his early 40s. And the president of the United States is in his early 80s.
We've seen this across the board. And at what point does the U.S. shift, and at what point do voters start pushing back? John Lieber's suggesting they're not at all. And they're actually consolidating around the no name, which is taking priority over younger blood. Does that shift at some point? Is there a pivotal moment akin to some of the things we've recently been seeing?
Concerning stuff from both sides of the aisle. An aging population, Lisa, and an aging Senate in a monster way. Let's head over to London and catch up on a central banking story. Janet Henry, Global Chief Economist at HSBC, joins us now. Janet, don't worry, we're not going to talk about the Senate and Capitol Hill and Washington, D.C. We'll talk about the European Central Bank and President Lagarde. What are you and the team looking for from the ECB chief a little bit later this morning?
Well, as you say, it's what we hear from the chief. No one's going to be surprised, seemingly, by the rate decision today. It's all about the policy guidance, if there is any, for September. And so I think, the first point will be, what do we hear in the statement? Do they change the statement rather than bringing rates to restrictive? Will it be stay at restrictive? I'd actually be surprised if there's any change in this statement, because then you have a half an hour gap before the press conference, and they really don't want to trigger any significant market volatility in that intervening period. But I fear it won't be any more exciting than the Fed meeting was yesterday. At least yesterday, they changed the description of first half growth from modest to moderate, so we're a little bit more upbeat. For the ECB, actually, the last couple of months have been some pretty ugly surveys on the manufacturing side, but I think it will be very much stating the fact that it's all about inflation still, and inflation, while finally moving at least a little bit in the right direction, is still stubbornly high. I don't think they want to change expectations here, and they want to still think there's more than less likelihood of a further rate rise in September.
That was the promo for the ECB decision a little bit later, a snoozer like yesterday. Janet, I don't think the data's a snooze at all, and I know you don't either. You've got Germany in recession. You talked about the survey data, which was terrible. And you've got a situation where inflation is still sticky. What is the relationship at the moment between growth and inflation in the Eurozone?
Well, we've got to remember the relationship is never perfect on a monthly basis. And this is also the issue for central banks when they're saying we're data dependent. And yet most analysis would say that a change in interest rates impacts on the economy over 12 months or more, and yet we're going to set policy on what happens to data over the course of the next couple of months. So inflation is too high, and given the labour market rigidities in the Eurozone, they know that once it does get built into wage pressures and the extent to which wages are linked to past inflation, it's much more difficult to squeeze out. So a lot of what they're trying to do with policy is to influence expectations and not leave anyone in any doubt about their intention to curb inflation. So I don't think I suppose the softening in the data has been more worrying than had been anticipated. And now it's not just about Germany. We've seen a little bit in the service sector, and we've even seen some softening in the service sector data from some of the other big four economies that have been somewhat more resilient, but not really enough to stay their hand at this point. It will depend on what they see in the next couple of months. And for me, inflation is still going to be above 5% for both headline and core. The reason to pause comes after September, where we still think they will be raising rates.
Yesterday, one of the reporters in the room asked Chair Powell how much of the inflation that we're seeing in the U.S. really can be controlled with interest rates the way that it has in the past. I would ask that of the ECB as well. If they do raise rates and continue to hold them at a high level, how much control do they have over bringing down inflation that has remained stubbornly sticky, even with the decline in loan growth?
Well, what you have in both economies actually is parts of the economy are definitely feeling the strain from higher interest rates. We know that. But we know that while some households and a lot of companies are feeling that strain and will continue to do so as those rate rises feed through, there are other parts of the economy that are feeling less strain. And certainly we see that in the US because inflation at 3% means real wages are now positive. So you're seeing consumer confidence improve to some degree, and we've actually seen growth hold up better than expected. So in many ways, the way in which they're using policy is to signal their determination to bring inflation back towards target. And for a central bank where their goal is price stability, they are explicit in that inflationary goal. That's what they need to meet, irrespective of what it means for the economy. And of course, for unemployment. I think, both central banks, they don't necessarily always say it explicitly, but they know that they are not going to return inflation firmly on a path back towards target without some significant rise in unemployment. And the Fed has obviously seen a lot more progress on the wage growth numbers than the Eurozone has. The wage numbers are still significantly higher than the US. And so that's why I think they're likely to have to go further than the Fed.
Given that the ECB is going to probably raise rates and keep them high for longer, how vulnerable is the Euro region to another bout of concern around the price of oil, around the price of natural gas, heading into winter, and even during this really hot period during the summer?
Yes, they escaped the impact of the full energy crisis because of a warm winter, but now a very hot summer could certainly mean that they take the toll as well. So gas prices, I suppose, are no longer falling, and they are, though, in terms of storage levels, still at quite high levels. So that is important. It's not just whether the spot price is actually moving up. But Eurozone consumers do seem to be more sensitive to the fact that other areas of inflation are still higher as well. They haven't seen the same degree of goods price deflation that the US has seen. They've seen an acceleration in service sector inflation. And we know that food prices, while wholesale prices have fallen back, actually we haven't seen that for processed foods. And we also know that potentially is going to be another area of volatility. So the broad story, and a number of ECB members have focused on core and the idea that core is still above 5 and they can't relax, at least until it falls below that 5% level, which certainly we don't expect them to have any sign of by the time of the September meeting. I think all of that matters. It's not just the gas price and the energy story, but other areas of commodity prices matter as well.
Janet, thank you. As always, Janet Henry there of HSBC going into that ECB decision, 90 minutes away. Inflation's at 5.5%. I have to say, I never thought they'd be able to hike 400 basis points at the ECB. I thought they'd struggle to hike again at one point in the pandemic, and here we are with the deposit rate set to go to 3.75 a little bit later.
Nobody thought they'd be able to get off negative rate policies without causing a massive debt crisis, and yet here we are.
It's amazing just how fast this bond market in Italy and Spain and elsewhere has transitioned to the reality of 4% interest rates at the ECB. From New York City this morning, this is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
what we saw from Microsoft and Google just further confirms what we saw from NVIDIA. I mean, the use cases are exploding across the board. And I look at this as a 1995 moment, biggest transformation that we've seen in tech in 30 years. And I think that's why this is just what's going to lead, obviously, despite Fed and macro. It's the start of a new tech bull market, in my opinion.
Dan Ives of Wedbush, bullish and right to be this year. Last year was a big struggle, but 2023, just wow. Meta up by close to 150% year to date before these earnings. After them, we're going to go through that level. Meta right now is up by close to 9% in the pre-market after beating estimates and providing guidance that there may well be more to come. Mandeep Singh joins us now, Senior Technology Analyst for Bloomberg Intelligence. Mandeep, just wow, they got it done. And the question I think lots of people are asking at the moment, is that just cost control, or are we seeing a re-acceleration in revenue growth? I spoke to an analyst later on yesterday who said, we're expecting the latter. Are you seeing the latter?
I think so. And look, it's both. Cost control is the primary driver of why the stock has run up so much, because the margins are trending in the right direction. But with inflation pulling back, it's good for ad spending. And that's what we saw that, from Alphabet. I think Meta was no exception. The one thing both these companies seem to be doing right is the pivot to AI and how they are using it to improve their ranking and recommendations in terms of the content that is being viewed on the apps. And that's what Meta called out yesterday. It's driving engagement in their Blue app, which everyone thought was a declining business. Well, it grew, and I think that is what AI can do in terms of driving that content engagement, which is the pull, really, to drive impressions. And, in an ad business, that is what matters.
Elisa mentioned earlier that Facebook notoriously is very good at copying other people.
Yeah.
Cough TikTok and Reels. How successful, how sticky has that product become?
So one data point they shared last night was Reels is now a $10 billion run rate business versus $3 billion last fall. And that just goes to show
trebled
3x.
Wow.
In a matter of 3 quarters. I think that just goes to show the point that, yes, they're very good at incorporating new features, but I do think it's going to cannibalize their existing ad inventory, the high-priced ad inventory, which is why in the print, the only negative I could find is the ad pricing went down 16%. We saw that from Snap. It was down 12%, and we thought it's a social media problem. In this case, they're actually cannibalizing their own ad inventory because Reels doesn't monetize as well as their other formats.
Of course, if you own the world and you earn a little bit less off of everything, you're still earning a lot of money. How much are we seeing them consolidate market share for the ad business versus simply just organically growing? In other words, is their gain someone else's loss?
Well, so look at messaging. Messaging, no one was able to monetize till now. Now messaging is a $10 billion run rate business for them, and they talked about incorporating AI agents. So the customer service use case for WhatsApp is huge. Again, we are still very early on, but the fact that they're talking about running digital storefronts who can do their customer service through WhatsApp AI agents, I mean, the market gets excited with these kind of things. And
can I just tell you, John? I get really frustrated when you go to a website and then you look for a phone number and there is no phone number. They're just chatbots. And then you discuss with the chatbot and they help you not at all.
I don't speak to the automated chatbots.
Well, but then you can't find a phone number so frequently.
You can find their WhatsApp channel now and you can talk to that channel. That's what they're trying to do with their...
Is it a real person there, though?
No,
of course not.
I've got no time for that, Mandeep. I want to speak to people.
I totally agree. I absolutely hear you. I am curious. With respect to Meta going forward, how much of their earnings had to do with crushing it on the advertising revenue, and how much had to do with the job cuts?
I mean, job cuts was a big factor, 25% layoffs, so they've already reduced their expenses $6 to $7 billion, and that shows up in the free cash flow. And they didn't cut anything on the Reality Labs side. That was the big surprise. They talked about raising their expenses on the Reality Labs front, so they're still going to lose $15 billion on building this metaverse again this year, and that's why the stock is not up more. Otherwise, I think investors would have cheered this print even more.
So you still think that deep down, Mark Zuckerberg's big hopes and dreams are the metaverse still?
Oh, absolutely. That was evident on the call. Like, he firmly believes in this. He thinks this will still drive the next leg of growth, but at the time, he's course corrected, pivoted to AI, rightly so, and that's been good for the stock.
Can you describe it? What does he have in mind? What does he think this is going to look like?
Well, so he thinks once he has the install base, and he's very focused on building the hardware where, he can have the content and control that ecosystem. He called out Apple for thwarting, their innovation and changing the rules all of a sudden, which hurt $10 billion of revenue last year for Meta. And I think he wants to control that ecosystem. But with Apple Vision Pro launch, I think at least it has validated the market. I still think they are spending way too much without really establishing a business case for metaverse. I don't think it's going to be that next computing platform that he thinks. It's probably too far out a bet, and losing $15 billion every year, I mean, investors won't like it. But at the same time, he's growing top line 20%, so you may get a pass for at least 2-3 quarters.
Is he investing enough on the other tech innovations, in particular artificial intelligence, as he tries to lean into the metaverse with dubious application and, frankly, a dubious leg up on some of the other areas, other companies that are developing this?
Yeah, so they are open sourcing their large language model, unlike ChatGPT or, some of the other ones. And what they're saying is, since they don't have a public cloud, they're going to partner with Microsoft and really make that available for consumption. So it's a good way to go about, driving adoption. But I still think, with large language models and how they're going to be monetized, I think public cloud vendors are the best position, which is why Microsoft and Alphabet got a bump from that.
As John was talking about, in about a week's time after the bell, we're going to hear from Apple, from Amazon. Is the expectation that they'll similarly deliver the better-than-expected results that we've seen from most of the other tech giants, Snap not included? Is this basically a telltale sign that the rally has been justified by fundamentals?
I mean, in the case of Amazon, you could see ad spending getting a lift because overall ad spending has improved. But AWS, I think because of their lack of exposure to generative AI, and the expectations are low, you're going to see a muted growth on that front. And Apple, look, we saw that from TSMC print. Smartphone demand is down. So I can't see how Apple beats on the top line. But at the same time, they still control the ecosystem, which Mark Zuckerberg doesn't like. And I think that's why they are where they are.
Apple earnings a week away based on our reporting. Maybe units this year are stable, don't change much from last year, but average selling prices are going to go up. That's the hope anyway.
The hope for who?
I imagine it
I was about to
materialises.
say, the hope
well, it's
for
the hope
shareholders.
for them and anyone who holds the stock.
Exactly,
At
not
the moment,
for anyone who's
Bremo,
going to buy.
mine's a few years old and I'm not upgrading it. Unless they do that thing they do where they sort of press those buttons and come in and slow it down aggressively, and then I've got to upgrade it. But right now I want nothing to do with it.
I understand.
What am I upgrading to?
Better.
Maybe you can run your large language model on your phone.
Large language model.
No interest in that at all right now.
Well,
I'm a
hear
late
you.
adopter.
I know.
On pretty much everything when it comes to technology.
I think that a lot of people were expecting that people wouldn't upgrade their phones as rapidly as the price went up, and they've been proven wrong every single time. Now, you've raised this. How much was that buy now, pay later, and how much was that fueled by some of the AT&Ts of the world, and the Verizons of the world, and some of the plans that they had? But I guess that we'll have to see.
Every luxury item on the planet, say every loosely, has been reduced to a monthly payment and not the sticker price. Pretty much everything over the last several years, including luxury, and we've talked about entry-level luxury. I wanted the connection that we've seen, and I know where you're going with this, the drop-off we've seen at Richemont, the drop-off we've seen at LVMH, how connected it is to the buy now, pay later phenomenon that exploded over the previous few years. How many people are able to go to Gucci and say, I want to get this thing that costs $5,000, and it's going to be $40 a month, $50, whatever it is.
And a lot of people associate Apple iPhones with luxury goods. Now, here's the other question, right? Are iPhones actually increasingly a staple? Because everyone's glued to them.
Without a
and
doubt.
It's a computer in your pocket that people use for everything in their life. So this is sort of some of the vagaries around some of the data we've been getting out from a lot of the companies.
Mandeep, thank you, sir. It's good to see you. Mandeep Singh there of Bloomberg. This from Dan Ives of Wedbush just moments ago. I came, I saw, I conquered. I'm not sure if Dan's talking about himself or if he's talking about the earnings. I suspect he's talking about the earnings so far this week from the likes of Meta and Google. Next week, as we've said repeatedly, Apple and Amazon, the runway through the rest of the year. Just into September. Let's go to September 20th, the next Fed decision. August 4th is payrolls. August 10th is CPI. September 1st is payrolls. September 13th is CPI. Somewhere in between, back end of August, I believe the 24th to the 26th. Jackson Hole. So that's your runway, Lisa, into September.
Can there be any big changes that we hear from Fed Chair Jay Powell other than we're still looking at it all, not sure?
We'll speak to a former Fed official and find out how boring he thought it was yesterday. Rich Clarida, the former Fed Vice Chair, now of PIMCO, joins us very shortly. Your equity market positive by 0.5% from New York. Good morning.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted.
I think the Fed's going to have to be, tighter for longer.
The good news we've gotten on inflation recently further emboldens the Fed to actually get to that 2% target.
This seems to have been very carefully put together so as not to send a dovish message.
I'm not exactly sure why they paused and why they hiked and what they're going to do next.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Nice and rested after a snooze and nap yesterday around 2:30 Eastern Time. From New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Chairman Powell and the Federal Reserve decision behind us. In front of us, the European Central Bank decision just around the corner, about an hour and 15 minutes from now. Tomorrow morning, it's on to the BOJ. Right now, this morning, equity futures positive by 0.5% on the S&P 500. Meta in the pre-market, a name we'll talk about a little bit later. Facebook earnings after the close, just tremendous, adding to the gains we've seen for the year so far. That stock is up by more than 150% now, Lisa. year to date. What a monster gain so far in 2023.
And you've asked the right question. At what point do people hold their nose and buy, even still, even though they've missed the rally, considering the fact they're delivering, and they're delivering above expectations at a time when their footprint is growing and they're consolidating market share.
More earnings this time next week from Apple, from Amazon. Meta right now up by close to 9% in early trading. Lisa, the Fed's behind us, the ECB in front of us. The ECB decision is very, very different to what the Federal Reserve is facing right now.
We saw yesterday a real lean into the soft landing narrative. We saw a Fed move back from recession as base case. Now it's that we're going to avoid a recession. You're seeing earnings come out stronger than expected. The ECB doesn't have that luxury. They see the data moving in the opposite direction. They see a situation where growth is slowing, inflation is remaining sticky, and they have to communicate something at a time where, do they believe in long and variable lags? Do they think that they're going to have some sort of impact if they continue to raise rates? What happened to all the hawkish people recently who've been saying really dovish things about maybe they don't have to raise again after going to 3.75%.
The bank lending survey concerning.
Yeah.
Is that by design or is it happening too quickly? We had a guest, Marvin Lower State Street, who said maybe it's happening too quickly. You mentioned the earnings. HSBC out this morning, just characterizing the earnings out of Europe so far as the most disappointing going back to the first quarter of 2020. You'll remember that. Stateside, you don't see much of that. McDonald's out just moments ago. Sales up by close to 12%. The estimate by a little more than 9%. That's an upside surprise, Bramo, from McDonald's.
And we saw the same from Coca-Cola, and we're seeing from a lot of consumer-facing products, in addition to the names like Meta and Google and many of the others. McDonald's shares up as people continue to buy. What I find interesting is it's on the lower end and on the higher end, even as we do see some signs of softening around the luxury players. I'm looking at the earnings. They were expected to show an earnings recession. I have heard some people try to poke holes in this earnings season, but the bottom line is the surprises have been to the upside repeatedly, particularly among the biggest, most resilient names.
McDonald's this morning, a beat on the top and bottom line. The stock is up by 2.4% right now. Let's get to the broader market. Fantastic guest just around the corner. Equity futures at the moment on the S&P 500, Lisa, positive by 0.5%.
So that ECB rate decision is at 8:15 a.m. We hear from Christine Lagarde at 8:45. The concern being that core inflation remains at about 5.5%, sticky high, regardless of how far the Fed is, how far the ECB, I should say, has already gone. 8:30 a.m. We get a slew of economic data: second quarter GDP, durable goods orders, initial jobless claims. The data has surprised to the upside of relative to expectations in the U.S. Is this a good thing? Well, maybe if the Fed is leaning into a soft landing and the idea they may not have to hike again. And today, the earnings flood continues. Before the bell, we get CBRE Group, New York Community Bancorp, Hertz, Intel and Ford after the bell. Intel, really key to watch as we talk about the preeminence of artificial intelligence and NVIDIA. They've missed out. This used to be the biggest chip maker. It is no longer. And how much they really talk about resurrecting that role with some sort of push into artificial intelligence.
Lisa, thank you. Been looking forward to this conversation all morning. Richard Clarida, the Global Economic Advisor at PIMCO and former Federal Reserve Vice Chair and a good friend of this program for many, many years. Rich, wonderful to catch up with you, sir. I was thinking back to our conversation we had on the West Coast when PIMCO put out their secular outlook, and you and I talked about what you called the Fed tolerating 2-point-something. Did you hear that from Chairman Powell in that news conference yesterday? Because I did.
Well, yeah. I think that you know they've had a lot to do. They've done a lot of heavy lifting. Ultimately, they do want to get inflation to 2, but they understand that if a year from now it's running in the 2s, that will have been a big accomplishment, and they can adjust rates down. They don't, they obviously don't want to tighten too much. And so, yes, I think 2-point-something is kicking and alive for sure right now.
Rich, it's worth going over what they're basically telling us explicitly. They're willing to cut interest rates with inflation above 2%. How controversial might that be?
I think they'll do a good job explaining it. What they're going to say is, look, as inflation falls, if the Fed doesn't cut rates, it's actually tightening policy, because policy is the real rate. So if the nominal rate's unchanged and inflation's falling, they're tightening, and they won't think they need to add additional tightening if they think the inflation momentum's going in the right way. So that's the way that they'll explain it.
The Fed was talking a lot about data dependency and how they really aren't giving forward guidance at this point. Did you get a sense of which data could really shift their views before September? Even though we do get a slew of data, we've heard every time them come out and say, one data point a trend does not make.
Sure, and I think so. They'll have two more inflation prints and two more labor market prints. But Lisa, I've thought for a long time that another important development that they're going to be following is what's going on in the labor market. They like the fact that the labor market is buoyant, but wages are going up faster than consistent with the 2% target. So I do think they'll be looking at the labor market data, wage, employment cost index, as well as the price inflation.
So what would they have to see? How high is the threshold for them to hike again in September, or if not in September, in November?
I think it's maybe a closer call than some of the market pricing right now. You know, they did write down two more hikes in June. We got one of them yesterday, and an overwhelming majority of the committee thought in June that appropriate policy would call for one more hike. So I think certainly one more hike is in play at some point in the fall. You know, the chair said that explicitly. He also said that when he was in Europe a couple of weeks ago. So I don't think it's an overly high hurdle to get that hike. I don't think they necessarily have to do it in September. I will say this, whatever hiking they think they need to do, I think they want to get in this year.
Why this year, Rich? Why is that important?
Well, I think a couple reasons. I think that I think they think they're close to the end anyway, and inflation's moving, however slowly, in their direction. And I think they would like to stay out of the spotlight in an election year. Now, we've had the Fed hike in election years, 04, 1984 come to mind, and they'll do that if they really think that inflation really requires a much higher rate path. But I think this cycle is aiming to finish up sometime in the fall.
You know that this Fed is always criticized. The committee always faces criticism for something. Some of the criticism we heard from some guest in the news conference before the news conference and after the news conference too was just how data dependent this Fed actually is. They took a break from hiking, Rich, then they come back and hike again. And in the intermittent period, we had inflation that actually improved. The inflationary backdrop seemed to get better, and yet they hiked anyway. How data dependent are they?
Well, good point. Data dependence is a very elastic phrase, which is open to various interpretations. I think on balance, really, going forward, especially after this meeting yesterday, they really are data dependent. As you know, I've said on your air before, most of this rate hike cycle, they've not been that data dependent. In March of last year, they knew two things. The funds rate was at 0 and inflation was at 5 going to 6. That's all the data they needed to set off this very aggressive rate hike cycle. I do think as we do get close to the terminal rate, that at the margin is more data dependent. Although I agree, and I said on Bloomberg after that meeting, it was an awkward pause in June, that's for sure.
It's an awkward moment also right now, given that the Fed is removing recession as the base case, and we're looking at a soft landing. And yet there's a real question mark among analysts and a real split among investors about whether inflation could reaccelerate as a result of the strength, the resilience, the wages. Where do you fall on this? What do you think the Fed falls on this, given that they seem to be taking perhaps a bit more of a dovish stance?
Yes, quite frankly, Lisa, I was surprised in the press conference. I wasn't surprised to hear the chair say, as he has many times, that he thinks there's a path to a soft landing. That's okay. Sure, there's a path, but I was surprised that he invoked the change in the staff forecast. I don't think that was in the June minutes, and so he's obviously entitled to do that. But yes, not my base case, not our base case, but there is a scenario where we get some good news on inflation this fall because of falling rents, used car prices again falling. But if the Fed finds itself in March of 2024 with an unemployment rate of 4 and an inflation rate of 4, with some of that temporary good news behind them, they're in a very tough spot. So I do think it's a risk. It's not the base case, but it's certainly something, if I were still there, I'd be assessing.
What do you think right now is the bigger risk, Rich? The idea of inflation reaccelerating and still being a problem, or the idea of recession and avoiding something more entrenched, which could happen if the Fed moves slower?
Well, personally, I do think that, again, I'm in the private sector now. I do think that the Fed, the bigger risk is for the Fed is to declare a mission accomplished too early and find themselves next year having to restart the rate hike. So if I were there, it would skew me to getting in, that additional hike this year. And I think some members of the committee will see it that way. Look, Lisa, the other thing is the Fed's own projection, which I agree with, has unemployment rate rising by about a point by the end of next year. That would be very modest. That would probably be the most modest downturn we've had. But historically, as we know, the Somme rule, whenever the unemployment rate rises by more than a half a point, it's ultimately declared a recession. So I actually think a truly non-recession outcome without any rise in the unemployment rate at all is going to be tough. That's my personal view.
Would be phenomenal if that materialized. I want to finish on this if we can, Rich.
Yeah.
No dissents. We talked about this yesterday. I've been talking about it for a while. You've been on the committee. Why do people, even when we know they might disagree with the decision, make the decision not to dissent? Why does that happen on the committee?
Well, you know, the Fed has been an institution that's been around for 100+ years, and there are certain cultural norms. And certainly, it's been a very long time since you've had a governor dissent on a policy rate decision. If you go back to the Volcker years, he had governors and his vice chair dissenting. But, you know, since Greenspan, but the Reserve Bank presidents can and do dissent. Certainly during my time at the Fed, especially in 2019, we had 3 dissents, and we had several presidents saying they would have dissented if they had had a vote. So dissents can happen. The other thing I should note is we've had a lot of turnover among the regional bank, district bank presidents. You know, the announcement of Jim Bullard, recently Esther George, Charlie Evans, Rosengren. You know, there's accumulated 50+ years of institutional experience that's no longer in that room. I think that's also relevant.
Richard, thank you, sir, for weighing in. Let's catch up soon. Next time in studio, please. Richard Clarida there, the former Fed Vice Chair and now of PIMCO. If you're just joining the program, welcome to the program. The S&P 500 positive this morning by 0.55%. Coming up in about 45 minutes from now, we'll catch up with James Athey of Aberdeen, looking ahead to the ECB rate decision about an hour from now. Bramo, most people anticipating a hike from the ECB, even with Germany in recession and the data this week looking pretty awful.
And you pointed out how earnings have been really disappointing in Europe and how different that is from what we're seeing in the U.S., whether it's McDonald's or, and this just caught my headline, Crocs just upgraded their full-year earnings per share, their forecast, and evidently Crocs are cool again. And I'm wondering how you feel about that, John.
I've got no idea what's cool anymore, based on the kind of things that I'm into.
Anyway.
And the kind of things that people are wearing these days.
I'm just looking at that and I'm thinking, that's going to be a field day of that. But
TK would do that. TK's far more fashion forward than I am.
Is he wearing Crocs? Can you imagine him wearing Crocs?
He came in the other day with leopard print Doc Martens.
Seriously?
I'm serious.
That's actually kind of cool.
With a beige suit. And next time he does it, I'll take a photo. Seriously.
And post it online. And we'll talk about it all day long.
Like a guess who?
But I don't think...
my shoes versus his shoes.
Well, I think everyone will know who it is.
Well, because his shoes are about 10 sizes bigger than mine.
Yeah, also you wouldn't wear leopard print. There's no way. I mean, come on.
No, not if you paid me. Like, seriously, not if you paid me.
I know.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. The ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
The ECB is still catching up.
They want to hike and show strength when they actually should show caution.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Are we at the end game for the ECB?
Those questions will persist up until Lagarde goes on that podium.
Coverage begins today on Bloomberg, your global business authority.
Chair Powell made it very clear in the press conference that he doesn't see the need to go that much further. The very fact that it's sort of meeting now tells you that he thinks that maybe there's one more rate hike, maybe there's no more rate hikes as we go forward.
Maybe they'll hike, maybe they won't. William Dudley, former New York Fed president, weighing in on that yesterday. Of course, now Bloomberg opinion columnist. Just moments ago, we caught up with the former Fed vice chair, Richard Clarida, who really presented in a very clear way what the Fed is telling us right now, which is that they don't think inflation comes back to 2% until 2025, that you could have this dynamic, which is reasonable, makes sense when you explain it, that you could have this situation where CPI is in the mid-twos and they're reducing interest rates. And the hope, I believe the dream of this equity market, and you can tell me whether you think this dream materializes, is that you can achieve that without unemployment spiking aggressively higher and GDP falling off a cliff.
It banks on this idea that the disinflation will continue and that we're not going to see a reacceleration of inflation, which is something that a lot of people disagree with, especially because of the strength that's leading the Fed, among many others, to call for a soft landing. Is this inconsistent? Even Rich Clarida, who was formerly on the show just moments ago, said he would err on the side of raising rates one more time in the fall to front load the hikes because of that concern.
The data this summer probably won't address this debate. It's the data in the back half of the year. The data this summer, most people anticipate, will conclude with disinflationary trends coming to the surface. Even the people who think it will reaccelerate expect that this summer. The real test is back end of the year, when we also get student loan repayments resuming as well, Lisa, and most people are writing stories about whether or whether that doesn't hit economic growth in a material way.
So how do you engage in data dependency without some sort of driving theory and driving expectation if the data isn't going to show up
Mohammed's
until later?
point, exactly. You've got to have some theoretical underpinning about what you're doing. You can't be hyper data dependent between meeting to meeting. And based on what we got yesterday, and this is what the complaints were about, and I know you're on board with this, if it really was meeting to meeting, why did they hike this time based on where the inflation data came in?
I would agree with that. I also think you have different theories depending on which Fed official, and they're just glossing over that by saying we don't have a theory, and we also don't have dissent, or at least there's the appearance of that. And I think we've discussed that. I think it's a valid discussion to be having.
The Federal Reserve behind us. Keep talking about the ECB. Really interesting discussion coming up a little bit later this morning. We'll catch up with James Athey of Aberdeen going into that decision. The decision a little under 60 minutes away. The broader market looks like this on the S&P 500, positive by 0.55% on the S&P. There's a lift in equities, a monster rally in Meta. That stock is up in the pre-market by close to 9%, up by 8.82% this morning, Lisa. Just adding some more weight to the rally for 2023.
What is it, 150% at this point?
It's nuts. It's through that.
It's ridiculous.
Through that now, yeah.
So then do you buy at this point? Do you say, all right, I'm in?
If I speak to analysts at the moment, and you're not going to get my Meta call, I'm never going to give anyone that. If you speak to analysts at the moment, the bullish ones, they think that a lot of the price appreciation we've seen so far this year is just cost reductions and cost discipline, and that we could see a reacceleration in revenue growth. And look, we saw some of that yesterday, and the stock is up again this morning.
And then you have the Leach Levines of the world who say rates will eventually come down, and you'll get that tailwind on the back end. And this, to me, again, it highlights how wrong everyone has been, considering that people were saying that tech was going to be the biggest loser so far this year.
And it's been the big winner in a big way so far in 2023. Joining us now down in Washington, D.C. is Bloomberg's Anne-Marie, our chief Washington correspondent. AMH, we have to start, of course, with some upsetting images from yesterday. Senator Mitch McConnell, who appeared to freeze in a news conference at a briefing. It's been raising questions about the age of people in the Senate. Of course, not just Senator McConnell, but Dianne Feinstein, another one who's really struggling at the moment on the other side of the aisle. How's this playing out, AMH, down in Washington this morning?
Well, you're correct, Jonathan. We wish the senator well, but he did essentially freeze. He abruptly, you can see it right there on the screen, stopped speaking for about 20 seconds. He then had to be ushered away. John Barroso there, the senator, asking him, "Are you okay, Mitch? Anything else to say?" Ushered away, but then he came back to the mic and said, "I'm fine." And I think in a politically charged moment about questions surrounding individuals' age, but it was very astute of Senator McConnell to say that the president called him and he said, "I told the president I got sandbagged." So basically also pointing out that, yes, we're all in this boat together, we're of older age, and we do have these moments, but it does raise questions about the older age, the aging elected officials we have. When Dianne Feinstein, the senator from California, came back from recovering from shingles, an LA Times reporter had this moment with her, asking her how it felt to be back, and she seemed very confused, as she had never left. She said, "What do you mean? I've been here, I've been voting." So there's been a lot of questions about the age of these elected officials, a lot of questions about Biden, his age, as he seeks re-election for 2024. And you look at some of the data, and a lot of Americans actually want to see upper level age limits on elected officials. But at the same time, a lot of Americans say older individuals are very wise, and they should be able to serve if they are healthy, and they should be able to do that if they have the cognitive mentality to do so.
Given the voter appearance of being okay with older politicians, how do you expect this to play out in terms of voter turnout, in terms of voters pushing back at all in next year's election?
Well, we're potentially facing an election where we have these two very old candidates. Biden is 80. You have a president who's in his former president who's in his late 70s who's seeking re-election. And poll after poll does show there is concern about Biden's age. Earlier this year, that NBC poll, it was staggering. About 70% said Biden shouldn't seek re-election, and more than 60% said they think he is just too old. So this is going to come up. And the issue really the Biden camp faces, and other elected officials face when you're in your 70s or 80s and potentially you're struggling, is what happens in front of a camera. Do you trip? Is there a moment where you have a gaffe? Is there a moment where you freeze on camera? And then the questions start to really rise, and can that derail a campaign?
MH, just before you go, when you cover a campaign at the moment, traditionally you would just focus on the politics. Unfortunately, we have to focus on the legal issues as well, not just around the president's son, but also around the former president, Donald Trump. What are you expecting to develop in the coming weeks?
There's a lot of legal issues, and there potentially is going to be more in the next 24 hours. So first, for the former president, potentially today, we can get that indictment. This would be his third indictment this year. This would be from the federal special counsel, Jack Smith, and this would be regarding overturning the election results of 2020 and January 6th. So potentially that could happen today. What it means for his election race is that he is just going to be bombarded with legal issues alongside the campaign trail. And then, of course, the president's son, current president's son, Joe Biden, Hunter Biden, yesterday had this plea agreement. It broke down in court. The lawyers from both the prosecution and defense went away, and potentially they will come back to the table with an agreement. But this just keeps Hunter Biden's name in the press and potentially poses some problems for the current president as he seeks re-election.
You're doing some construction over there, Anne-Marie.
It's above me. It's the floor above
Someone's
me.
doing
I'm not sure what.
Okay, all right. Go sort
They're
them out.
building me a new studio for 2024.
Very cool, as they should. Anne-Marie, thank you. AMH down in Washington, D.C. Got no idea what was happening then.
Real time.
Wasn't sure if that was AMH sort of banging a table or someone hammering through the ceiling.
Yeah, exactly. I figured someone was taking off the shoe, their Croc, and slamming it on the floor.
We should have talked about
exactly. She has strong feelings.
You need a law degree right now to follow politics in Washington, D.C. It's nuts.
It is crazy, especially when the headlines are coming out every day. So Hunter Biden supposedly had a plea deal that may or may not have fallen apart. We are still waiting, I believe, to find out what the latest on that is and what the negotiations are there. The former President Trump has said that he is going to revive his complaints, his allegations of the election being stolen from him.
Okay.
If there is some sort of prosecution for January 6th situations. I mean, all of this rhetoric kind of taking the oxygen out of the room a little bit of the political debate.
The silly season really gets going next month when it gets super quiet in Washington, and
That's what
yeah, you know when it starts to get really crazy.
I mean, we're already talking about dogs.
I know. Then the campaign picks up, and you've got to talk about that for 18 months. Coming up shortly, Chris Marangi of Gabelli Funds on an equity market that's doing pretty well this morning, up by 0.6%. Meta, upside surprise, stock up 9%.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Equities this morning, and good morning. Positive on the S&P 500, a lift here on the S&P and on the Nasdaq too. We're up by 0.6% on the S&P 500. On the Nasdaq 100, up by 1.2%. Meta getting it done in more ways than one. Their stock is up by close to 9%. We'll talk about those earnings in just a moment. In the bond market, 2-year, 10-year, 30-year, shaping up as follows. Going into the ECB later. Yields lower at the front end of the curve, down by 3 basis points. 482 on a 2-year, on a 10-year. Basically unchanged at 387. Elisa, following the snooze fest yesterday afternoon.
Some people called it a Rorschach test, that you could make of it what you wanted, given the fact that they seem to endorse the idea of a soft landing and endorse the idea that they weren't necessarily going to hike again. At least they weren't on any kind of preset path. We heard from Rich Clarida. He thinks the market is a little too confident they're not going to hike again. I am curious about what the threshold is for deep summer data for them to really shift away and surprise the market with another rate hike.
You heard from an official there 30 minutes ago who was burnt burnt by the inflation story. And I would say Chairman Powell was burnt earlier this year as well, when he started to embrace the disinflationary trends that he thought was emerging and then had to back away from that conversation. That's going to shape their approach to this through the summer.
Which is true, and that's why some people are saying they could make the opposite mistake by getting too hawkish because they're trying to correct a mistake they made earlier. Underneath all of this, Tom Keene, if you were sitting here, would say it's the pandemic economy, it's the pandemic recovery.
Careful about channeling TK. Okay.
But, I can wear my leopard shoes. There is going to be an issue going forward. How much do Fed officials buy into the immaculate disinflation that seems to be underpinning the soft landing hopes that we keep hearing from so many economists and Fed officials?
Privately, I'm sure they're dancing around hoping and praying.
100%.
Publicly, I think they're going to be very reluctant about doing that. Let's turn to the FX market just briefly. Euro stronger for a second session. The euro against the dollar, 111.36, positive here by 0.5%. Under surveillance this morning, an ECB rate decision due at 8:15 a.m., so 45 minutes from now. The announcement coming after the Fed raised rates by 25 basis points, left the possibility open of doing more. Meanwhile, in the UK, this one's interesting going into the Bank of England next week. We're reporting that advisors to the Chancellor of the Exchequer, Jeremy Hunt, are worrying that the Bank of England risks raising interest rates too much, potentially pushing the economy into recession. So we've got the BOE next week, Lisa, the ECB just around the corner, BOJ tomorrow. BOJ tomorrow is pretty interesting, you know, because out of everyone, out of all these central banks, Federal Reserve, ECB, Bank of England, they view the inflationary uptick as an opportunity. Not a problem, an opportunity to reset inflation expectations.
And there are some people talking about possibly abandoning the yield curve control or the peg that they've had. I can't imagine that's going to happen.
Reports suggest it won't tomorrow.
I can't imagine that
they've surprised before, but
yeah,
who
but
knows?
It's been a long time. They've been moving in the opposite direction. Will the rest of the world, to your point about the UK, join their view of things? That if you let things take their course and play out, there will be this sort of disinflation. You'll allow yourself to have an economy that isn't destroyed by some sort of deep recession. But we were having the same discussion 6 months ago.
It's super transitory. Yeah. Just like, you know.
Exactly. Push it out. But we were having the same discussion 6 months ago, particularly of the Bank of England. And then inflation surged higher, and oh yeah, the economy did better than expected. So at what point do you take that and say, wait a second, we need to pay attention. We're not understanding some influence here that's keeping strength going, and also, on the flip side, inflation.
It doesn't happen in a straight line. I find the ECB decision today to be pretty confusing. What do you do when growth is really disappointing, but inflation is still a problem? They've got an inflation mandate, 2%, single mandate. It's unlike the Fed. They don't really have the luxury of backing away anytime soon, which is why most people assume, Lisa, they hike later on this morning.
And then how do they guide forward at a time when the hawkish members are starting to say, maybe we should be a little bit more concerned about how much we've already done?
That's the central bank talk. Let's briefly talk about some of the earnings this morning. Upside surprise from McDonald's from about 30 minutes ago. Yesterday afternoon, upside surprise from Meta. The stock is up by close to 9%. Everyone's using Reels, apparently, Lisa, this short video format that you know well, which is basically just to compete with TikTok. But tech, you've got to say it, getting it done so far, validating some of the moves based on what we heard from Alphabet and what we heard from Meta overnight.
Upside surprise after upside surprise, advertising such as point of strength. Meta in particular, and we were talking about how they really are good at copying successful technologies and taking advantage of technologies that have some sort of pall cast over them. And this I find interesting. TikTok, the question around Chinese ownership, they get in on Reels and can get popular. The company formerly known as X, suddenly a question around Elon Musk's leadership and guide. They start Threads, and they're cheered for it. At what point do they sort of get a pass because they take advantage of these opportunities of contention in the tech world?
You can't stand this X thing, can you? Can you imagine if Twitter was reporting earnings, how bad that might look right now based on what's happened in the last few quarters? That's the tech story. Just remember, Microsoft was a soft spot. I would say the soft spot of the week. Biggest one-day drop on Microsoft stock yesterday, going back to January, I believe. Let's get to this final story. A car carrier with nearly 4,000 vehicles, including BMWs and Mercedes, is burning off the coast of the Netherlands. This fire, we're told, according to the Dutch Coast Guard, could last for days. The vessel, Lisa, listen to this, twice the length of a football field, and trying to prevent it from overheating so it doesn't sink and leak fuel. Just an amazing situation there. this morning.
Potentially an ecological disaster. I'm looking at some of the details, and they say that still the cause of the fire is unknown. Some pretty horrific images at a time when the car manufacturers are all reporting earnings. So it's a very difficult moment, given the fact that a lot of the cars on this ship belong to companies that have been reporting earnings throughout the morning.
Mercedes upgrading their outlook yesterday. We talked about that briefly, didn't we? This a year or so ago, can you imagine supply chains and what everyone would be talking about? It's sort of like this will get brushed under the carpet. But a year or so ago, it's been like, car prices and
then we would get into
stories.
Totally,
Stories totally change. Chris Morangi joins us now, co-CIO at Gabelli Funds. Chris, wonderful to catch up with you, sir. Can we just start with something that I know that you've been doing well with, Meta? Chris, talk to me about what we heard yesterday. Did you like what you hear?
Yeah, we like what we heard, and as is the market apparently. So, we thought that follows a pretty strong report from Google and even Microsoft, which had a very high bar to clear. And we saw some confirmation that users are returning, that advertising is pretty good, spending's under control. They took out some of the overhang of increased CapEx in 2024. And listen, they can possibly earn $20 in 2024, and that makes the stock look pretty cheap here.
A lot of people push back against some of the enthusiasm around artificial intelligence and say that the results that have been positive in the tech names have come from the nuts and bolts of their business, advertising, even cloud spend, albeit that was somewhat softer than expected. Are you still leaning into the AI story? Are you looking past that and saying fundamentally these companies are still making money and that's why you want to lean in?
Yeah, it's early for AI, obviously, to have an impact. And Meta got in on the AI story as well. They talked about it a bit, and they've got a little bit of a different approach. We're probably not going to see that play out in earnings for some time. But there's a scarcity of ways to play AI. And that's why you've seen names like Microsoft and Google, and to a lesser extent Meta, really benefit from that story. AI is going to change the world. Not quite sure how it happens and how we profit from it, though.
How have you shifted your views or the names that you're really leading into as we do get earnings, as we do get this backdrop of a potential soft landing?
Yeah, you've said it a bunch of times. Soft landing, the market sniffed that out sometime in June. Earnings, though, thus far have been pretty confirmatory of that outcome. And I think the market is reflecting that in some of the broadening of performance to the small caps, which tend to be a little bit more cyclical. So we've always had a bias towards smaller companies, less covered companies, industrials. And we're seeing a benefit there, and like a lot of those stocks, notwithstanding some of the great performance from companies like Meta and Google.
Chris, can you walk me through that decision to buy Meta after the complete mess of the last quarter of 2022 when things started to look really bad for that company? What did you see that you liked at the time? What was the framework, the process that you and the team went through to identify that name as something you should buy?
Well, listen, we've been following the company for a very long time. We have a core competency in media here, and Google and Meta fall into communication services. They're in many ways media companies. They eat advertising. But one of the concerns that we've always had was the out of control spending. When they talked about the year of efficiency, we knew that even if we did hit an air pocket in the economy, Google and Meta and others would have some cushion in being able to reduce their own expense bases to maintain margins, maintain earnings, and they've done that.
Chris, there's a hope now that revenue can re-accelerate. And when people discuss taking cyclical exposure, can you talk to me about taking cyclical exposure in some of these tech names?
Yeah, I mean, they are going to be the beneficiary. They are exposed to advertising. More than half of advertising is digital, and most of that is controlled by two companies, Meta and Google. And they are going to be a beneficiary of a cyclical upturn, maybe to a lesser extent from the tsunami of political spending that's going to happen next year. But core advertising remains soft. We also saw Comcast this morning, which actually put up very good results, although one of the nicks there was advertising, as expected, down about 5% at NBC. So linear television remains a little weak. We're over a year into an ad recession there, but that's going to turn around at some point. And by the way, that should benefit Meta and Google.
Meanwhile, Chris, Gabelli has been really vocal about the need to consolidate your bets around a number of names that you know and have conviction in. How has that played out? How much have you broadened that out versus continued to really focus on a number of key names that really do seem to represent the trend and the strength in the economy right now?
Yeah, we've always tried to stick with what we know, and there are certain sectors that we just don't play in because they tend to be commoditized or we just don't understand them. But we've got enough that we can understand, and we can benefit from different dynamics in the economy. There's certainly acyclical or less cyclical components of, say, consumer discretionary, the cable companies, broadband companies that have a substantial subscription business, as well as the more cyclicals, the metal vendors that go up and down with the economy. So we've got a pretty diverse portfolio that can take advantage of whatever happens.
Chris, when you have a monster winner, whether it's Meta or another tech name, how do you make the decision to cut, to move away, to lock in the gains after a short period of time? What goes into that?
Well, we're always looking for a margin of safety. And an ideal case, you've got two lines. You've got your private market, what we call our private market value, and the public market value. And if that margin of safety, the gap between those two lines, remains consistent with what we'd expect, we're happy to own. We're happy to own forever. We tend to have very low turnover in our portfolio's, but if that margin of safety narrows, we'll trim or exit. And in the case of Meta, they've been able to grow earnings, and the multiple has expanded a little bit recently, but it's really still an earnings story.
Well, Chris, wonderful to catch up, and congratulations on a wonderful investment so far. Chris Morangi of Gabelli Funds. Meta looking better and better as the days roll by. The stock leads are up 9% this morning.
You asked the right question. When do you decide to cash in?
Right.
When do you decide to say this is pretty good at this point? And Chris had a good answer to it. I do wonder, though, at some time, you do hear people saying, maybe sell on the margins and then shift into some other areas.
Cyclicals.
Yeah.
How much have we heard that?
I know.
It's like on repeat for the last month or so. If you are just tuning into the program, welcome to the program. The S&P 500 right now is positive by 0.6%. It's the countdown to the ECB now, about 30 minutes away from that decision. We'll catch up with PGIM Fixed Income's Catherine Nice. Looking forward to that conversation on the European Central Bank. And ultimately, what happens beyond the 25 basis point hike, Bramo, we all expect from President Lagarde and the Governing Council in the next 30 minutes or so.
And at a certain point, I do wonder, and we discussed this earlier in the show about that loan survey that showed such a steep drop-off in loans. And we heard about how it probably was too quick for the ECB's comfort. At what point do they highlight that in the meeting, that there are signs of some serious credit contraction, making it difficult for them to really get overly hawkish at this point?
Is that what they want to see? I think this is the one for me. You can acknowledge the bank lending survey, but it's how you characterize it. Is it by design? Is that something, the intended consequence of policy? Or is the pace at which it's happening unintended and unwelcome and maybe slightly nerve-wracking for some of them on the committee?
Well, Marvin Lowe said that it was too quick. He said that this is not the orderly fashion that they'd like to see. And if that's the case, if they pause and they can see whether it evens out, maybe they'd opt for that kind of thing. But are we past the point where ECB and Fed officials want to communicate hawkishness in order to jawbone the market to some kind of response? That seems to be one of the key questions. Do they care about easing financial conditions?
You picked up on the right word, I think. Is it orderly or is it disorderly? And we'll find out from the ECB president in the news conference that comes 30 minutes after that decision. A little bit later, a conversation you might not want to miss. Gary Gensler, the SEC chair, is going to be joining Bloomberg at 11 a.m. Eastern Time. From New York City, this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
There's a certain uncertainty on the side of the customers in terms of inflation, but I personally don't expect a recession in the next quarters. I expect a small growth, 4 to 5% for the automotive industry next year, and this is also true for the major regions, mainly US and Europe, and China perhaps a little bit lower.
That was the VW CFO following earnings a little bit earlier on today. The car earnings so far, Mercedes-Benz raising their outlook just yesterday. Europe at the moment not looking tremendous, let's put it that way. Germany in recession, the PMIs, the survey data you get on things like manufacturing and services. We got that earlier this week and the data didn't look great at all. But the ECB still has an inflation problem. Inflation, core inflation, still has a 5 handle. And the ECB wants to get that down to 2. So most people believe they're going to hike interest rates a little bit later, in about 30 minutes from now, another 25 basis points. Joining us, I'm pleased to say, is Catherine Nice of PGIM Fixed Income, who writes the following. It seems too soon for the ECB to declare the job is done in terms of bringing inflation back to target. And so we expect a hawkish tone coupled with language that keeps all avenues open for September and beyond. Catherine, I'm pleased to say, joins us now. Catherine, wonderful to catch up with you. Let's start with this ECB decision. 25 basis points in 25 minutes is what most people anticipate. How difficult does this decision become as the growth backdrop starts to look worse and worse?
It's going to be hard for the ECB to thread the needle. They've got to acknowledge that the euro area economy is weakening. You mentioned some of those recent data coming in. Some of them have been weakening, quite markedly. And yet the backdrop is that inflation remains uncomfortably high. If I compare the euro area to the US, we're just not seeing that consistent, compelling message coming from the data that near-term inflationary trends are dropping off. So for them, they're going to need to try to strike a balance between keeping their options open in September without sounding overly dovish. Tricky balance.
Especially at a time when we're hearing some confusing rhetoric out of previously uber hawks on the board. How much has that colored your view in terms of confusing the message a little bit at a time when inflation clearly is the preeminent concern for central bankers whose mandate is exactly getting price stability?
Well, I think it's a signal that the central bank is getting near to peak rates. So whether or not they raise rates in September, again, like others, and you mentioned it earlier, I expect the ECB to raise 25 basis points today. That's pretty much what they've told us to do. But whether they do so again in September, I think stepping back, big picture is that we are near peak rate based on what we're seeing from the data now, but that the ECB is likely to hold rates at these higher levels for quite some time. So perhaps it's that pivot point that's being reflected in some of these, the change in tone in some of the comments that you mentioned.
We were talking about this, about how the loan survey showing the steepest drop-off in decades in terms of loan creation in the Euro region is potentially a problem for an ECB that would like to see an orderly credit tightening. How do you expect them to frame this? How do you view this as affecting the European economy?
I expect that this is going to be a key data point that is going to inform their decision today. That's what the chief economist had mentioned, in previous communications, and it is a key input. It's telling us whether or not the transmission mechanism is working, and these data certainly do suggest that it is working. If we just do a mechanical backing out of the PMIs, which are generally speaking a pretty good indicator, a near-term indicator of economic activity for the euro area, we're looking at a euro area that is effectively stagnating. That's one thing. But is this potentially the beginning of a steeper and more marked contraction? And I think that's going to be the question mark over this ECB bank lending survey that you mentioned. That, of course, would be a concern. It's not the base case, I think, at the minute, and that stagnation seems like the more likely outcome, which is why I suspect that rates are probably near their peak, but then stay at that relatively higher level for some time until we see that near-term inflation momentum coming off.
When you meet with your US colleagues and they talk about the difference between the US and Europe right now, Catherine, can you run us through the unique underpinnings of Eurozone inflation and why it might lead to a period of stagflation? Do you think that's underappreciated at all?
Well, I think one thing we have to acknowledge is there is a war on the doorstep of Europe, and further negative supply shocks are definitely plausible. And it may not be the base case, but I think it would be premature to rule them out entirely. And so Europe is exposed in this way that the US is not exposed in the same way. So that's one thing. I think a second point as well is that, you know, throughout this period, inflation has been high everywhere, including US and Euro area, but really the primary drivers have been quite different. In the US, it's really coming from a very strong domestic economy. So in some ways, that's easier to address through domestic policy via what the Treasury is doing with fiscal, what the Fed is doing on monetary policy. In Europe, a big driver of inflation has been energy. That is not within the gift of the ECB to control what's happening to wholesale energy prices. So it's a more difficult task, I think, for the central bank there. And then, of course, the ECB, is ever present having to deal with the potential of fragmentation risks. That too, I think, sets it apart from the US. So I think it's just more of a challenge in the Euro area to get us back to a steady state.
Catherine, if we could do just a little bit more scenario analysis, if you will. If we went into a period of stagflation in Europe, would this central bank be constrained by the fact that it has a single mandate, inflation? And how would you play that through the bond market? Could you just give me an idea of how you'd think about that kind of dynamic?
So the ECB's remit is different from the Fed. They don't have the dual mandate, as you said. So they're really only focused on price stability. They can choose how price stability is obtained, and their independence is enshrined in the treaty. So in a lot of ways, people do say the ECB is probably one of the most independent central banks out there in terms of the governance framework. And that, of course, will be reflected in the choices that they are making in terms of policy. But I think that said, recently, there was a bit of a wobble from the central banks, but I think both the Fed and the ECB have done a good job in terms of taking back control of the inflation narrative. And markets are much more confident now that rates are near their peak and that central banks are going to deliver on their inflation targets over the medium term. And that's going to help reduce volatility and continue to support more generally this pickup in the search for yield that we've been seeing more recently.
Catherine, thank you for being with us going into this ECB decision. Catherine Nice there of PGIM Fixed Income. The ECB about 20 minutes away, Elisa. The prospect of stagflation in Europe is going to be a much, much bigger conversation, particularly if inflation remains as sticky as it has been in the Eurozone.
And you raise a great distinction between the U.S. and Europe, with Europe having a single mandate and the U.S.'s Fed having a dual mandate. At what point do they start to question whether they're actually effectively bringing down inflation with monetary policy? Again, how much do we have to ask? Have we lost the transmission of some of these policies after so many years of terming out debt into very low rate types of instruments?
Well, Europe specifically, much more highly dependent on the banking channel. And given the data that we've had recently in the bank lending survey, you'd have to believe that would hit growth and then bring down inflation. We've certainly seen it hit growth. At the moment, we're waiting to see if it brings inflation down in a sustainable way.
And this is where perhaps the pandemic distortions come into play, because the labor shifts and some of the demands on the wage side have challenged how quickly inflation can come down, which is the reason why the Bank of England has had the incredibly unsavory type of view to say, just stop asking for raises. And that hit like a bag of
anything that went down. I mean, honestly, the way economists have talked about this inflation problem is just it doesn't resonate with the public.
You saw actually Fed Chair Powell understand that, and yesterday saying, we actually like it when wages increase more than the underlying inflation, because he didn't want to be cast in the same kind of tone that we could see the Bank of England officials being cast in when they say things like, just stop asking for
And that's the real dream, isn't it? You want stable prices, but you want the pay rise. That's
basically,
the real,
yes.
Of course.
You're going to take this personal, 100%.
Hey, let's make it personal. It's personal for everyone. James Athey of Aberdeen on the European Central Bank joining us next. The ECB decision just around the corner, expecting another 25 basis point hike.
We have been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted.
I think the Fed's going to have to be, tighter for longer.
The good news we've gotten on inflation recently further emboldens the Fed to actually get to that 2% target.
This seems to have been very carefully put together so as not to send a dovish message. I'm not exactly sure why they paused and why they hiked and what they're going to do next.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The ECB coming up next. President Lagarde expected to hike 25 basis points. That decision is 15 minutes away. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Bravitz, I'm Jonathan Ferro. Your equity market is positive by 0.6% on the S&P. Meta has been up in the pre-market by anywhere between 8 and 9% through much of this morning. Royal Caribbean, cruise line operator, the fifth best performing stock on the S&P 500 so far year to date. That name is up by more than 100%. Came out with earnings just moments ago, raising the full year guidance. And listen to this new range. Full year adjusted EPS, $6 to $6.20. The previous forecast, Lisa, $4.40 to $4.80. That is a big upgrade.
Which is the reason why you're seeing the stock surge higher. It had been higher, much more. It has come off some of the earlier highs. Here's the question. How much longer can consumers keep spending on vacation? Is this a secular shift? We also saw Hertz earnings earlier this morning beating expectations, even though used car prices were falling off because people are paying crazy prices. Have you rented a car recently? It's really high. It's gone up significantly, and people are still paying them. So at what point do people run out of cash? It was supposed to be now. It's not happening.
Beat and raise, Royal Caribbean, all over the place. To Lisa's point, the stock is up by 9%, but you've touched on the most important theme. Discretionary spending, away from tech, we talk about tech all the time. Discretionary spending has been a massive theme for this year. The airlines are up big, something like 40% plus for some of them. American, United, Delta. The cruise line operators, 3 of the top performing 10 stocks on the S&P 500, Royal Caribbean, Carnival. There's 2 of them. There was a third in there as well at one point. Lisa, those names have been flying all year. Does that last beyond the summer? And as we get to the back end of the year, as things like student loan repayments resume, do we take that hit to discretionary spending that a lot of people are expecting? And if we don't, then that inflation story starts to bite back, and we have a very different conversation about the Federal Reserve.
And if we do see that start to fall off, then all of a sudden is recession back on the table? Is the whole concept of soft landing not as preeminent, which raises this really odd tension at a moment where the Fed was embracing the soft landing, saying we are seeing strength and this is a good thing, and inflation should still fall off, and we're not sure, but we may not have to raise rates again. Is there an inherent conflict here as we look at all of these earnings come out that show that consumers have not yet run out of cash? They're still willing to pay prices that are substantially higher.
Which is why you hear the chairman in the news conference yesterday aggressively trying to retain optionality. Acknowledging the improvement, but at the same time saying, who knows, I'm not going to tell you what I'm going to do next. And that's going to be the game for the rest of the summer, isn't it?
I love that. That was the most diplomatic thing I've ever heard you say, John. Maintaining maximum optionality. This is the words
Don't
of saying.
accuse me of being diplomatic.
This is the words of basically saying he said nothing, and he's going to do whatever he's going to do, and they're not giving forward guidance. And that's basically what we saw yesterday. Maximum optionality, indeed. Basically, you know, we could raise.
Back in the saddle, isn't that what Mike Apin said? What was that quote? Back in the saddle with maximum optionality.
Something like that.
That was Mike Apin of Bank of America. Let's turn to the price action on the S&P 500, up by 0.7% on the S&P. In the bond market, yields unchanged at 387. Lisa went through the economic data that you can expect a little bit later. We get GDP, we get jobless claims. Labour market's going to be a big focus, of course, Lisa, because at the moment, unemployment's at 3.5%. Claims, we had the right kind of downside surprise last week on jobless claims. I mean, much better than expected. Doesn't scream recession right now, looking at some of those indicators.
It doesn't even scream any kind of softening in the labor market, which was something that the Fed has said that they wanted. Yesterday, though, we heard a different tone from the central bank. We heard that maybe they could get to some sort of decline in inflation without losing jobs. I mean, we've gone to the no pain type of scenario, which brings us to Jackson Hole. Are we going to hear any kind of resurrection of we need to take pain, this is going to be rough, and oh yeah, it's 8 minutes, I'm going to go? I mean, is that what we're going to hear this time around?
Haven't seen that pain, have we? I imagine it's going to be a very different address if we get one. Based on his comments yesterday, maybe he doesn't turn up to do a speech at Jackson Hole. He didn't seem too interested. The runway for the rest of the week, the ECB in 10 minutes' time. After you get that decision, 30 minutes later, we'll have the news conference. We'll take that here on Bloomberg TV and Bloomberg Radio. Overnight into tomorrow, the BOJ. That's the central banking trilogy of the week. The Fed yesterday, the ECB, then the BOJ, then on to next week is the Bank of England. Joining us now for a preview of the ECB, Athey. James Athey, Investment Director at Aberdeen. James, much harder decision for the Governing Council and the European Central Bank. The Fed has the luxury of saying growth is good, the labour market's strong. Right now, I'm not sure President Lagarde can go into that news conference a little bit later this hour, James, and say growth is good. Is this a hard one for her?
Hey, John, I mean, you could argue it's a little bit easier because, again, the transmission for monetary policy to influence inflation is largely via demand. So, if anything, the ECB is facing a slightly easier task because they can see that demand and forward demand through things like the bank lending survey are already softening and softening significantly, which suggests that their policy is further into restrictive territory, and maybe they can more convincingly consider the end. Whereas, as you guys were just discussing, if the US consumer doesn't die down, if the US labour market doesn't soften, it's difficult to believe that they've found equilibrium, and it feels like they would have to come back to the table. So the communication is difficult because we're moving from this very backward-looking policy stance into something highly data-dependent. Central bankers know that markets have a tendency to get carried away, and they don't want that easing of financial conditions. But that's a problem they cannot really resolve. I think we'll see a very similar outcome today. Non-committal, not really full of information.
Meanwhile, we've been talking about the bank lending transmission mechanism in Europe, and John rightly pointed out that it is more sensitive to this type of contraction, which we've heard and we've seen. What are you experiencing? What are you seeing on the ground in terms of how quickly credit is contracting in the Euro region?
Well, I mean, that's difficult to say on the ground. I think we all have to rely on the data as we see it. And I look at the contents of the bank lending survey, and I think more pertinently on the demand side than the supply side. Of course, supply conditions matter. They always do. But what matters for judging the stance of and transmission of monetary policy is more about the demand for loans, and we can see that really does look incredibly soft across the Eurozone. If you look at the sort of pre-pandemic estimates for neutral rates in Europe and the US, maybe 0.5% in the Eurozone and maybe 2.5% in the US. There's 200 basis points between them, but actually there's only 150 basis points between the cash rates. So that alone suggests that European policy is already tighter than US policy, and I do think we see that in the data, and that's without even getting to the structural challenges in the Eurozone.
We're going to talk about some of those challenges now on the ground in Frankfurt, Germany. Bloomberg's Maria Tadao outside of the ECB headquarters. Maria, just frame how difficult this is going to be for the European Central Bank in 30 minutes' time for President Lagarde when she has to deliver that news conference.
Well, this is going to be a very difficult communications exercise for the head of the European Central Bank, because on the one hand, we know they will hike 25 basis points. That was the guidance to the market, and everyone is well calibrated for that. But the big question is what happens next. And you've talked about this range of data, some of it very soft when you look at the PMIs. And it wasn't just Germany this week. You also had significant downturns coming also from economies like France. We also had that London survey, which we know they look at, but then core inflation sticky. So again, the market will be focused on any guidance, any bias potentially in this decision, but I'm not sure they want to do that. If anything, the European Central Bank, you could argue, wants to go for the most neutral possible, the most options open. Look at the data, say we go back to very data dependent and look back in September where we are. So I think it's going to be a tricky exercise. There will be a lot of questions to try to get an indication of where they want to go, but I'm not sure she wants to do that yet.
You follow the speakers. We heard from Klaas Knot of the Netherlands recently in the last couple of weeks. The individual members of the Governing Council, the traditional hawks, Maria, do you sense from them that even they are unsure about what comes next after July?
Yeah, and remember, Jonathan, this was presented today, July, as a, quote, necessity for the central bank. When it comes to September, we've seen maybe it's now 50-50, maybe it's now an open call, maybe we need to look at the data again. They're waiting for new projections in September. So I think there's been almost a rethinking over the past 2 weeks. What I'm also curious to hear about is, and this will be, I'm sure, a question, is this idea of rate cuts potentially earlier than expected. That would be the worst case scenario for the central bank, to have inflation that is above target and get all this chit-chat in markets about potentially, because of the state of the economy, cutting beforehand. I'm also very curious as to see, can she shut it down and how will she push back against that idea?
We're about 5 minutes away from that ECB rate decision. Still with us, James Athey of Aberdeen. And James, I'd love your take on the data dependency, the maximum optionality that we're hearing, certainly from the Fed, and as Maria was suggesting, from the ECB coming up as well. What data are you honed in on? Are you going to be trading more aggressively on data in a new way?
Yeah, I mean, that's unfortunately the game of investing. It really is John Maynard Keynes' beauty contest. Much as I would like to look more heavily at the most forward-looking data, the fact of the matter is that the markets are still somewhat focused on the most lagging indicators, that's jobs and inflation. So I think some balance between the two is probably the right path to tread. I agree with Maria completely. The ECB really doesn't want to give a strong signal one way or the other. There is definitely persistent weakness across the manufacturing sector. That's much more significant in the Eurozone than it is in the US. We're now starting to see softening in the service sector as well, and that is good news. But of course, none of these central banks want to box them in. You know, to nick John's words, they want maximum optionality. So some sort of obfuscation, constructive ambiguity is what we're likely to see. I think once these risk events are out the way, the market at the moment is in the mood to then run with the themes and the trades that it wanted to run with anyway. So I think we saw that in the US last night. Weaker dollar, risk on, probably lower yields for the summer. That's what I'm expecting, and I don't expect Madame Lagarde to necessarily put a hole in that this afternoon.
Do you expect the dollar to weaken and the euro to strengthen because of the US or because of Europe's actions?
Well, I think the dollar is weakening because it's become a bit of a self-fulfilling prophecy. The market always has a bias to want a weaker dollar because risk tends to perform better in a weak dollar environment. The market has been and continues to love the carry trade. That generally involves at least selling dollar as an intermediate step. But I look at the dynamics currently, and it doesn't necessarily look like a weak dollar environment to me. US rates are higher than European rates. The European data is rolling over far more quickly. As a general rule, that looks like a reasonably solid dollar environment versus the euro. So we're marginally long the dollar here. We think already the market's got a little bit overexcited. But short term, as I say, the market tends to run with the themes it wants to. I think positioning is a bigger headwind medium term.
What's
you
new
see
about
what you
that,
want,
James?
right?
I know, it's always the way.
Exactly. Everybody sees what they want to.
It's always the way. James, I just wonder, I know what investors want. They'd like a big easing program out of China. Do you think that's what policymakers on the Governing Council would like to see right now? Would that be welcomed by them?
Yeah, I mean, that's a really good question. I'm not sure there's necessarily a huge supply-side stimulus from China easing aggressively, so that might actually complicate their picture, add to demand without an offset via supply. I think the central bank would like to see inflation closer to 2% by hook or by crook, and then they can worry about the balance between supply and demand and how stimulatory or how restrictive their policy is. For what it's worth, I don't think China's going to engage in the sort of massive stimulus we've seen in 2015, 16 or 2007 and 8. I think there's a lot of adjustment and fiddling around the edges. I don't think they're going to go back to the sort of debt-funded infrastructure investment stimulus that we've seen historically. So I don't think there's a massive impulse for Europe coming from China.
So far, lots of people would agree with you. We are about 60 seconds away from that ECB rate decision. Before I get to that, I think we've got to talk about the prospect of a European central bank hiking into stagflation. We have a situation at the moment where inflation has a 5 handle, where the economy in Germany is in recession, and we're having a conversation in about 50 seconds time, Lisa, about another interest rate hike at the European Central Bank. It's a much tougher environment, I think, at the moment for the ECB compared to the Federal Reserve, which is facing a situation of growth which is still okay, unemployment which is still low, and inflation which is heading in the right direction.
And that's the reason why, as Maria was saying and James was agreeing, they're probably going to have a similar type of tone of say very little and maintain maximum optionality as they try to chart forward. How does the market play that as we do get data points? Do the data really start to take on new significance, John?
I'm not going to take credit for maximum optionality because I'm pretty sure I just ripped that off Mike Gapin of Bank of America. I said aggressively retain maximum optionality. It was just the flavour of Gapen from BofA. The decision is seconds away. Sometimes it comes out a little bit later, a little bit after 15 minutes past the hour. We're looking for a 25 basis point hike rather, and you get a 25 basis point hike from the European Central Bank. The main refinancing rate goes from 4% to 4.25. The marginal lending facility goes from 4.25 to 4.50, and the deposit rate goes from 3.50 to 3.75. So a 25 basis point hike from the ECB. As widely expected. Lisa's going to go through the various headlines and work through the statement over the next couple of seconds. I just want to work through the markets just briefly, give you the knee-jerk response reaction to this information. 2-year yields in Germany lower by 3 basis points. The 10-year is down by about 3 basis points as well. The reaction for the single currency, not a big one at the moment. The euro against the dollar, euro-dollar, about 111.25. On the session, positive by 1/3%. And just coming back just a touch. Lisa, what do you see?
That the ECB coming out, it's saying that inflation is still expected to remain too high for too long. So really doubling down on that, saying that they will continue to follow a data-dependent approach. There's that maximum optionality potentially. We'll see more. They said also that inflation will further over the remainder of the year. Basically, the goal here is to ensure that rates are sufficiently restrictive. This ends up becoming a question around what does sufficiently restrictive mean at a time when this same body, the ECB, is saying that inflation is expected to stay above target for an extended period of time. Is that meaning that there still is sufficiently restrictive rates if you do have inflation that still is too high, John?
Just want to work through the statement for you, the full body of that statement. Just a couple of quotes to share with you all. The developments since the last meeting support the expectation that inflation will drop further over the remainder of the year, but will stay above target for an extended period. While some measures show signs of easing, underlying inflation remains high overall. The past rate increases continue to be transmitted forcefully. Financing conditions have tightened again and are increasingly dampening demand, which is an important factor in bringing inflation back to target. I think there's a subtle nod there, Lisa, about the tightening financial conditions in the bank lending survey, and endorsing it in many ways, welcoming it, because they need to get inflation back towards target.
It's by design. That is the goal, to try to reduce some of this credit lending. Some of the questions for Christine Lagarde, I'm sure, will be, is that enough? What does that do for them in terms of suggesting how far that transmission mechanism is moving forward? Right now, looking at the euro, not getting that much of a reaction. Really, this is going to be in the statement and in her answers to questions that are going to try to get some kind of guide forward that she probably won't give.
A slightly weaker euro off the back of it, just about holding on to 111 at the moment. That currency pair is now positive, just 0.2%. Around the decision when it dropped, it was positive by 1/3. Just on future ECB decisions, the Governing Council's future decisions will ensure that the key ECB interest rates will be set at sufficiently restricted levels for as long as necessary to achieve a timely return of inflation to the 2% medium target. The Governing Council will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, its interest rate decisions will continue to be based on its assessment of the inflation outlook in light of the incoming economic data, etc., the financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. Maria Tadeo over in Frankfurt with a chance to read through a lot of this. Maria, your thoughts on what we've just heard?
Yeah, and you see a little reaction because a lot of this is by the book. We're expecting this, and the European Central Bank had really guided that they would hike 25 basis points. Today, when you look at some of the language in the statement, I mean, we've seen this before. They do go back to being data dependent, but again, we were expecting that. They also talk about sufficiently restrictive. Again, the question is, when do you go into, we've done enough, so the lag is just the key now. We don't need to do more. And I think, to me, the real takeaway, however, is there is no indication about September. There's little guidance in the statement, which again reinforces the importance of this press conference. And again, the mistake perhaps, or the biggest risk for Madame Lagarde going into this press conference is that the market perhaps could tilt one way or another if indeed they want optionality, but there's a perception that there is a tilting in a bias here. So if they want to keep options open, she's going to have to thread this very carefully with the language and the tone that she uses.
How could she justify, Maria, not hiking further if inflation remains as sticky as it is? I mean, it's a fairly simple question, given that core inflation is 5.5%, and their one mandate is to bring down inflation.
Yeah, it is a single mandate central bank. And of course, they look at headline inflation that cools down as soon as energy prices go down. But we know they focus on core inflation that is still at 5.5%. So not a lot has changed on that. I think the fundamental question, and this is the biggest intellectual debate that is going on in this bank, has to do with the transmission. It takes, and we know there's a lag between what you do now and the implications that you see in the economy, not just headline inflation, but also core inflation and dynamics there. They want to be able to see or make sure that what they've done will be enough, or maybe it's not enough. And that's why September is still at play. That's why she'll justify we need to hike today. That was a necessity, but the future path, this is unclear. Probably it's going to be an open call going into this meeting. And again, you do see that with the weak PMIs that we saw this week, that London survey too, the trade-off between the economy and inflation becomes ever more difficult for the central bank.
Hey, Maria, thank you. I know you've got a news conference to get into. We appreciate your time. Maria Tadeo there over at ECB HQ at the headquarters of the European Central Bank. That news conference starts in about 24 minutes' time for Christine Lagarde and the ECB president. If you are just tuning in, welcome. 25 basis point hike from the ECB, and rather like the Federal Reserve offering very little guidance about the future. The phrase of the last 24 hours sort of fed maximum optionality. I think that phrase, of course, applicable to the ECB this morning based on what we've heard so far. The euro selling off a little bit following the decision. Near session lows, the euro still just about positive. A break of 111, though, at 110.98. We roll over there. A rally in the bond market in Germany. The two-year yield there is now lower by 8 basis points to about 3% on a German two-year. James Athey of Aberdeen back with us for a little bit more. James, just some thoughts on this decision. Do you get the feeling, and I wonder if this is endorsed in the news conference, that this ECB is starting to put more weight on the growth data and maybe a little less, just respectively, relatively speaking, on the inflation data?
Yeah, I do, John, and I think that's absolutely right. It was the early phase of this process was very much a case of central banks just being in completely the wrong ballpark. They had monetary policy which was effectively easier than 5, 6, 7 years of low growth, low inflation, and they were staring down the barrel of this wild money growth and incredible inflation dynamic. So those first 6, 9, 12 months were very much about catching up. But the later you get into that process, the later we get into the cycle, the more they have to be looking out of the front window and less looking out of the rear window, because as yourselves and Maria have just said, we know that these policies operate with lags. The transmissions are not well understood. Economists don't really like to admit this stuff, but our understanding of this complex machinery is very partial indeed. And so, at some stage you have to try and balance the various considerations, even if you just have an inflation mandate, because again, the only way that monetary policy can influence inflation is the very blunt way of being a headwind to demand. And so it is natural and reasonable, when you think you're getting closer to the end of that process, to start to consider forward inflation, to start to consider your forecasts for inflation to a greater degree than data released today, which tells you more about where policy was a year ago.
Right now we're seeing a little reaction, although on the margins you are seeing a rally in German bonds, and you're hearing, as John mentioned, a bit of a softening in the euro versus the initial reaction versus the dollar. Is this enough to really get you a sense that this is a more dovish or less hawkish ECB, and give you confidence to even lean into European sovereign bonds a little bit more?
I think the problem, Lisa, is that a data dependent means that my forecasts for the economic data probably matter more than my assessment of the reaction function of the committee, of the individuals on the committee. I did think, and again, this was something you guys mentioned earlier, I did think that the speech by Klaas Knot was really significant, because he's been a dyed-in-the-wool hawk, and he really did elucidate this idea of the risks of policy error shifting more and more towards the hawkish era. I think that's very relevant information, but if we're all wrong about the inflation outlook and core inflation goes from 5.5 to 6, not 5.5 to 5, then it's no use that we thought that the ECB was evolving in a dovish direction today. And that is why there has been such a tricky market environment, because actually the economic data itself has been rather volatile and rather difficult to explain through a kind of all-encompassing macro lens.
James,
that being said, medium term, I do expect it to slow.
We've got about 60 seconds. If you could, a question for Lagarde in this news conference for the press. James, what would it be?
I knew you were going to ask me that, so I was thinking
So
about a question for Madame Lagarde. Yeah, I was thinking I would ask her about the balance sheet, because it occurs to me that, you know, lots of central banks think the balance sheet is magic. It's a wonderful stimulus on the way up and it's completely inert on the way down. But if the ECB really is still concerned about inflation, why it is that they refuse to engage with the idea of PEP reinvestments, because they've just confirmed they will continue to go on year after year. And to me, that still feels a rather strange situation to be in.
Interesting. We've known each other so long that I'm that predictable these days. James Athey of Aberdeen. James, thank you, buddy, as always. Here's the guidebook, the runway through the next 10 minutes or so. So in 5 minutes' time, you'll get some economic data in America. We'll get some GDP numbers, initial jobless claims, all of that good stuff. Lisa and Mike McKee will break that down. They'll be caught up with, they'll be catching up with Vince Reinhardt of BNY Mellon Asset Management. So look out for that conversation. Going through the opening bell after that news conference wraps up. It will start, by the way, with President Lagarde in 20 minutes' time. We'll come out the other side and break it down with Winnie Caesar of Credit Sites and Peter Cheer of Academy Securities. All of that still to come. Data in America in just a moment. A press conference with Christine Lagarde starting in 20 minutes' time. And an equity market that's elevated through most of this morning. We're positive by 0.7%. From New York, this is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
back. This is Bloomberg Surveillance. 15 minutes away from Christine Lagarde's press conference following raising rates by 25 basis points at the ECB, just seconds away from a slew of U.S. economic data, including the second quarter GDP reading, as well as initial jobless claims at a time when the Federal Reserve and the ECB likely will be looking to maintain maximum optionality. In other words, they're not going to predict what they are going to do next. Right now in markets, you are seeing the NASDAQ leading the gains, up almost 1.5% following the results from Meta. We're seeing a bit of stability in bond markets, yields just slightly higher, with 10-year yields at 3.88% as all of this data does come in. Right now, let's head over to our own Michael McKee for a breakdown. Mike.
Good morning, Lisa. We've got a lot of numbers for you here, and it's a better than expected GDP report for the second quarter. This is going to have the Fed changing some of its forecasts, 2.4%, which was what the Atlanta Fed GDP Now yesterday said we would see. 1.6% personal consumption. That's down from 4.2% in the final revision to the first quarter GDP. So maybe that gets revised up. Core PCE, the price index, I'm sorry. Let's do price indexes here. 2.2% on the quarter for the headline and 3.8% for the core. Now, jobless claims, if this is at all possible, they are still falling. 221,000 last week, 228,000. Continuing claims, 1,690,000. That's down from 1,749,000. So not as many people getting jobless claims, not as many people filing for initial jobless claims. Durable goods orders come up 4.7% after a 2% gain in the month of May. And capital goods orders, non-defense, ex-air, sort of the core of this, up 0.2%. That's after a 0.5 gain the month before. Shipments were flat during June, which is kind of interesting given the strength that we see in GDP. Lisa, I'll let you check the markets because I'm trying to get the latest GDP numbers and see what the breakdown is and how this all worked out.
I'll let you do that. Right now, what we are seeing is not a lot of drama, but we are seeing yields shift upward, particularly at the front end, by a couple basis points as people parse through what this better than expected data means. You are seeing stocks retain their gains. Again, not a massive reaction, especially given the earnings that have been stronger than expected. The euro weaker versus the dollar, continuing that trend, 110.75 after the ECB came out and raised rates by 25 basis points. But after this stronger than expected U.S. data, that to me is probably the biggest mover, with a decline of about 0.1%, the euro falling versus the dollar. Mike, you've had a second to really parse through some of this, and I do want to ask you whether this kind of raises a question about whether the Fed can have its cake and eat it too. Stronger than expected growth, yet when you take a look and you dig under the hood, it looks like the price index came in more than expected. Jobless claims coming in, basically Goldilocks?
I would quote Jay Powell and say I'm reluctant to use that word at this point, but it does suggest the U.S. economy remains strong, retains some strength, even at 5.25% Fed funds rate. The consumer spending was interesting because it falls to 1.6%, but that got revised up twice in the first quarter. So that might be revised higher. Business fixed investment, business spending really jumps. It was negative in the first quarter. It was up 4.9% overall. Non-residential fixed investment, which is kind of business spending, 7.7%, led by structures, up 9.7%. We knew that was happening. And equipment, 10.8%. So businesses went out and spent a lot of money during the month, and that is good news for the overall economy. Looking at the rest of this, I've got to scroll down here to inventories and see what happened with inventories. Let's see if I can find it right here. Not finding it immediately.
Mike, why don't you take a minute to parse through all of the data? It's been a massive amount of numbers, and we'll get back to you in just a little bit. Right now, I really want to get through what we're looking at in terms of, is it a soft landing or is it a head fake? And I'm pleased to say that we're joined by Vincent Reinhart, Chief Economist and Macro Strategist at Dreyfus and Mellon. Vincent, what's your take on the slew of data that we just got that really highlights both a soft landing and, on the margins, disinflation?
We probably heard it from Chair Powell yesterday. Importantly, he said that the board staff had taken out their forecast of a recession. And Mike noted that GDP wasn't a surprise to the Atlanta Fed that had an estimate of 2.4% growth this last quarter. Board staff invests a lot of resources in doing the same thing. So I don't really think that this morning, certainly from the national income accounts, was that much of a surprise. Big question is, does it make it more or less likely there's a soft landing? Sure leans that way, but it's one data point. That's what Chair Powell would say at this point.
What do you make of initial jobless claims? Second consecutive month that there's been an upside surprise, or at least a positive downside surprise. Basically, there are fewer people filing for unemployment than previously expected in the prior month. How does this confirm with the idea that we need a loosening labor market in order to achieve disinflation?
Yeah, so the other part of soft landing is no productivity, that we are getting very strong employment growth that is at least matching that in output. We're not gaining anything in terms of output per hour. Among other things, that means that wage gains are more serious because there's no cushion between what firms pay workers and what they produce. I think that among other things, the main takeaway is tight labor market is fueling household income, and household income is supporting consumption.
Which is
hard to get a recession that way.
Which is a reason why some people are wondering whether this is somewhat of an uncomfortable rationale, that you're seeing strength in the economy, and yet the Fed is moving away from any forward guidance of further rate hikes. Do you think that this is a mistake, that there wasn't a greater indication to markets that the Fed did plan to raise rates again once in this particular year, considering that Rich Clarida earlier on this show said that he, if he were still on the Fed, would vote to raise rates again this fall?
Well, last guidance was that they would raise rates in the summary of economic projections. Chair Powell is pretty confusing. He wanted to assert very strongly that every decision is, every meeting is live, that every meeting is made based on the data. But in fact, there seemed to be guiding us to a slower pace of policy firming, 12.5 basis points a meeting on average. That sounds like a committee that is, number one, divided, and number two, pretty close to the end.
Do you get the sense, as you look through this data, that there is strength in the economy, that perhaps they're not really watching closely enough, that there does seem to be something that could reignite inflation later in the year?
So I think they're watching closely the data. They see the strength in the economy, and if you're Chair Powell, you're encouraged by it. He's never really had a hard landing in his outlook. I think that the extent that the strong data is coming from the labor market, it's got to be troubling. It's got to be a reason why you have to lean toward more policy firming. And I think it does pose a fundamental challenge.
Are you concerned that there isn't more dissent, at least publicly, on the Federal Reserve at a time where, as you said, it was somewhat confusing, and it seems as though there's a bit of a herding cats type of trend going on there?
So I think we saw, the division in the committee just by the two press conferences in a succession. In the June meeting, the chair spent a lot of time talking about all they'd done was slow the pace, slowing policy, tightening, allows more information to gather. But this time it must have had a yellow sticky note on his talking point saying, say meeting by meeting, live, data dependent as often as you can. That suggests to me that he wants a slow pace of policy firming, so he's got optionality. May or may not tighten in November, but he's got enough restive colleagues saying, nope, every meeting is live. Go out there and remind everybody every meeting is live. That's a division in the committee. We'll see probably better in 3 weeks when we get the minutes.
In about 5 minutes' time, we'll get maybe a sense of what's on the sticky note, the yellow sticky note of Christine Lagarde. In the meantime, I do want to head back to Michael McKee, who's been parsing through all of the data. Mike, what stands out to you in the details, the fine line items underpinning GDP, underpinning durable goods?
Well, GDP, the interesting thing here is we've seen a couple of months where inventories and trade really affected the numbers, but not in the second quarter. They both subtracted about 0.1% from the overall number. They kind of offset each other, and the real strength was in business spending, up 1%, and consumer spending up 1.1%. So that makes up most of what we saw during the second quarter, and it does suggest strength. Government consumption was up 2.6%. That's down from 5% in the previous quarter. Non-defense spending, which was up 10.5% in this first quarter, was down 1.1%. So not a huge contribution from the government this time. It's consumers and business spending, the C&I part of C plus I plus G plus NX. And in terms of durable goods, it's just overall good news that there is some spending, but it did slow in the capital goods non-defense area. So we'll see what kind of contribution that we get from durable goods when we go into the next month. I think the Fed looks at today's numbers and obviously has to change their forecast for GDP for the year at the September meeting. And the jobless claims numbers just tell the Fed that we're not going to see unemployment start to rise in the near future. So they may have to adjust those as well. And this is the kind of report, I guess, that keeps them on alert, not going to make them make a decision because we're a long way away from September 21st, but keeps them on alert for the possibility of having to raise rates again.
Thank you so much, Mike. Great synopsis there, especially as we start to see increasing momentum or at least stability in the consumer. Vincent Reinhardt still with us. Vincent, how long can consumers keep spending like this at a time where we're seeing results from the likes of Hertz, from the likes of Royal Caribbean? That trend is still in place.
So a couple things. They still have the retained fiscal transfers they got in 2020 and 2021. They've worked down a lot of that mound, but they still have that saving. And second is we're generating jobs and wage growth is strong. That means they're getting household income. 2 points to what Mike said. I actually see a lot of the government in the GDP print, and that's incentives for capital spending. I think that's part of the reason capital spending was so strong, given all the green initiatives. Second thing, inventory is on the soft side. The closest relationship of business loans to economic activity is the inventory component. So some of the softening in bank lending we've seen might actually be demand, not supply and credit constriction.
And that's what we've seen over in Europe as well. It was a drop-off in demand, not necessarily on the supply side. As you parse through this, though, are you watching things like the student loan repayments? Is that going to really play a role, or is it really going to have to come from some, I guess, tightening further in a way that might be a little more disorderly?
So I think it's got to be the latter. I.e., at this stage in the monetary transmission mechanism, it's the credit constriction that Jay Powell is waiting for. It is going to be, the cumulative toll of the earlier bank runs. And by the way, quantitative tightening is actually starting in earnest only now. First year of the program, when the Fed ran off its securities holdings, the Treasury paid for it by working down its cash balance at the Fed. Just moved money from one pocket of the government to another. Now, with the Treasury keeping its cash balance at a high level, all the security redemptions the Fed is doing is going to be coming out of the assets the private sector holds. Quantitative tightening is really kicking in now.
We're just minutes away from Christine Lagarde giving a press conference. It's scheduled to be 8:45. However, there usually are a lot of photos and introductions, so it may be a couple minutes after that. Vincent Reinhart with us of Dreyfus and Mellon, and inevitably one of the questions that Christine Lagarde will field will be oil prices, gas prices, how that affects the outlook, how that affects inflation, how that affects their role. As we talk about that, we're seeing oil prices climb to the highest levels going back to April and climbing, hitting $80 a barrel for the first time since then. Vincent, how does potentially higher oil prices, higher energy prices more broadly affect a debate that has really been supported, the disinflation, by lower energy prices?
Much harder for Christine Lagarde to answer that question than Jay Powell, because the U.S. is an energy balance. We're actually net energy exporter. For the European economy, an enormous energy importer, in which case an oil price shock is just nothing but bad. It adds to cost, but it also pulls out income from domestic residents to the foreign sector. A good portion, as you note, of the favorable inflation dynamics at the headline level over the last 6 months has been the decline in commodity prices generally, energy specifically, and the repair of the goods market. Repair of the goods market is continuing in the sense of supply chains getting better. But the reversal of energy prices is going to add to cost in Europe and is going to hit demand through income.
Vincent Reinhart of Dreyfus and Mellon, thank you so much for being with us. We are seeing pictures of Christine Lagarde walking out to the lectern ahead of her press conference after raising rates by 25 basis points to 3.75%, the highest rate going back a very long time. We are expecting to hear her reiterate some of the maximum flexibility. They did talk about inflation remaining too high and wanting to hold rates at a restrictive level for a prolonged period of time. That really becomes a question, what does it mean to be sufficiently restrictive? Let's take a listen to what she has to say.
My name is Wolfgang Preußel. We are also joined by journalists on WebEx. As always, if you want to ask a question, please turn on your camera and also the microphones. And with that, I'd like to hand over to President Lagarde, please.
Thank you, Wolfgang, and good afternoon to all of you. The Vice President and I welcome you to our press conference. Inflation continues to decline, but is still expected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. The Governing Council, therefore, today decided to raise the 3 key ECB interest rates by 25 basis points. The rate increase today reflects our assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. The developments since our last meeting support our expectation that inflation will drop further over the remainder of the year, but will stay above target for an extended period. While some measures show signs of easing, underlying inflation remains high overall. Our past rate increases continue to be transmitted forcefully. Financing conditions have tightened again and are increasingly dampening demand, which is an important factor in bringing inflation back to target. Our future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary to achieve a timely return of inflation to our 2% medium-term target. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, Our interest rate decisions will continue to be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We also decided to set the remuneration of minimum reserves at 0%. This decision will preserve the effectiveness of monetary policy by maintaining the current degree of control over the monetary policy stance and ensuring the full pass-through of our interest rate decisions to money markets. At the same time, it will improve the efficiency of monetary policy by reducing the overall amount of interest that needs to be paid on reserves in order to implement the appropriate stance. The decisions taken today are set out in a press release that is available on our website. The details of the change to the remuneration of minimum reserves are provided in a separate press release to be published at 3:45 Continental European Time. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity first. The near-term economic outlook for the euro area has deteriorated, owing largely to weaker domestic demand. High inflation and tighter financing conditions are dampening spending. This is weighing especially on manufacturing output, which is also being held down by weak external demand. Housing and business investment are showing signs of weakness as well. Services remain more resilient, especially in contact-intensive subsectors such as tourism. But momentum is slowing in the service sector. The economy is expected to remain weak in the short run. Over time, falling inflation, rising incomes, and improving supply conditions should support the recovery. The labor market remains robust. The unemployment rate stayed at its historical low of 6.5% in May, and many new jobs are being created, especially in the services sector. At the same time, forward-looking indicators suggest that this trend might slow down in the coming months and may turn negative for manufacturing. As the energy crisis fades, governments should roll back the related support measures promptly and in a concerted manner. This is essential to avoid driving up medium-term inflationary pressures, which would otherwise call for a stronger monetary policy response. We welcome the recent Eurogroup statement on the euro area fiscal stance, which is consistent with this assessment. Fiscal policies should be designed to make our economy more productive and to gradually bring down high public debt. Policies to enhance the euro area's supply capacity can help reduce price pressures in the medium term while supporting the green transition, which is also being furthered by the Next Generation EU programme. The reform of the EU's economic governance framework should be concluded before the end of this year. Let's look at inflation. Inflation came down further in June, reaching 5.5% after 6.1% in May. Energy prices fell again, dropping by 5.6% year-on-year. Food price inflation continued to slow but remained high at 11.6%. Inflation, excluding energy and food, edged up to 5.5% in June, with goods and services following diverging trends. Goods inflation decreased further to 5.5% from 5.8% in May. Conversely, services inflation rose to 5.4% from 5% in May, owing to robust spending on holidays and travel, and also reflecting upward base effects. The drivers of inflation are changing. External sources of inflation are easing. By contrast, domestic price pressures, including from rising wages and still robust profit margins, are becoming an increasingly important driver of inflation. While some measures are moving lower, underlying inflation remains high overall, including owing to the persistent impact of past energy price increases on economy-wide prices. Although most measures of longer-term inflation expectations currently stand at around 2%, some indicators remain elevated and need to be monitored closely. Turning now to our risk assessment. The outlook for economic growth and inflation remains highly uncertain. Downside risks to growth include Russia's unjustified war against Ukraine and an increase in broader geopolitical tensions, which could fragment global trade and thus weigh on the euro area economy. Growth could also be slower if the effects of monetary policy are more forceful than expected, or if the world economy weakens and thereby dampens demand for euro area exports. Conversely, growth could be higher than projected if the strong labor market, rising real incomes, and receding uncertainty mean that people and business become more confident and decide to spend more. Upside risks to inflation include potential renewed upward pressures on the costs of energy and food, also related to Russia's unilateral withdrawal from the Black Sea Grain Initiative. Adverse weather conditions, in light of the unfolding climate crisis, may push up food prices by more than projected. A lasting rise in inflation expectations above our target, or higher than anticipated increases in wages or profit margins, could also drive inflation higher, including over the medium term. By contrast, weaker demand, for example, owing to a stronger transmission of monetary policy, would lead to lower price pressures, especially over the medium term. Moreover, inflation would come down faster if declining energy prices and lower food price increases were to pass through to the prices of other goods and services more quickly than currently anticipated. Let's look at the financial and monetary conditions. Our monetary policy tightening continues to be transmitted strongly to broader financing conditions. Risk-free interest rates over short to medium-term maturities have increased since our last meeting, and funding has become more expensive for banks, in part owing to the ongoing phasing out of the ECB's targeted longer-term refinancing operations known as TLTRO. The large TLTRO repayment in June went smoothly, as banks were well prepared. Average lending rates for business loans and mortgages rose again in May to 4.6% and 3.6% respectively. Higher borrowing rates and the associated cuts in spending plans led to a further sharp drop in credit demand in the second quarter, as reported in our latest bank lending survey. Moreover, credit standards for loans to firms and households tightened further, as banks are becoming more concerned about the risks faced by their customers and are less willing to bear these risks. Tighter financing conditions are also making housing less affordable and less attractive as an investment, and demand for mortgages has dropped for the fifth quarter in a row. Against this background, the annual growth rate of lending continued to decrease in June, falling to 3% for firms and 1.7% for households, with annualized growth rates of 0% and -0.2% in the second quarter, respectively. Amid weak lending and the reduction in the Eurosystem balance sheet, the annual growth rate of broad money fell to 0.6% in June, with an annualized growth rate of -1.1% in the second quarter. To conclude, inflation continues to decline, but is still expected to remain too high for too long. The Governing Council therefore today decided to raise the 3 key ECB interest rates by 25 basis points. Our future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary to achieve a timely return of inflation to our 2% medium-term target. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will continue to be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions. Thank you.
Thank you, President Lagarde. And the first question goes to Jana Rando of Bloomberg News. Jana, please.
Good afternoon, Madam President.
Good afternoon.
2 questions, as always. Does the absence of guidance for September, I assume you expected such a question, mean the Governing Council is equally open to another hike, to a pause, or even to the conclusion that rates have already reached their peak? That would be the first. And the second one, I'm wondering how much of your decision on lowering the remuneration of minimum reserves has been, or how much of that was driven by concerns over central bank losses? Thank you.
Thank you very much for your 2 questions. You know what, let me just remind you what we have been doing. And I'll come to your interest, which is what happens next. But let me just remind you what we're doing and what we have been doing. We are raising interest rates, all 3 rates, by 25 basis points. And this is the 9th decision to hike that has been taken in a matter of 1 year. So invariably, one meeting after the other, we have raised rates. The DFR is now at 375. And this decision that was unanimously agreed amongst all members of the Governing Council is driven by one key determination, which is to bring inflation to target. Our target, which is medium-term inflation. There is unanimous determination to do so. What have we decided as well? And I'll come to your minimum remuneration because that was your second question. We have also decided, and I'm going to quote because it's a sentence that you might hear over and over, not this time, next time, and future times. We say, our future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary to achieve a timely return of inflation to our 2% medium-term target. So some of you may have noticed a slight change of a verb. And that is not just random or irrelevant. And I think it's predicated on our determination to be data dependent. So I have said on many occasions that we had ground to cover, or we have more ground to cover. What I'm saying here is that data and our assessment of data will actually tell us whether and how much ground we have to cover. So we are deliberately data dependent, and we have an open mind as to what the decisions will be in September and in subsequent meetings, because this determination based on data might vary from one month to the other. So we might hike and we might hold. And what is decided in September is not definitive. It may vary from one meeting to the other. So I hope it's very clear that we are not in the domain of forward guidance, but we are very strongly rooted in our determination to break the back of inflation and to take inflation back to 2% medium term on a sustainable basis. And to do that, we will be informed by data, we will analyze the data, and we will then decide at that point in time, we will have the inflation outlook, we will have 2 readings of inflation with all the underlying dissection and understanding of it, and we will have even more understanding of our monetary policy transmission. And that will be repeated every governing council after every governing council, so that we can make sure that, as I said, we break the back of inflation. Now, on your second question, our primary job is to set monetary policy so that inflation stabilizes at 2% over the medium term. No dispute about that. But we also have a public duty to make the implementation of our monetary policy as efficient as possible. So by cutting the remuneration on minimum reserves only, that's the basis that we will use, cutting it to 0, we will reduce the amount of interest that we pay, which means the implementation of our policy is going to be more efficient. At the same time, it is going to have no impact on our policy stance, which is currently determined by the remuneration, not on minimum reserves, on excess reserves, which, as you know, are far plentier than the minimum reserves. So that's the decision that we made. More efficiency, and that's also, of course, predicated on the principle of proportionality.
Thank you, President. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you very much for taking my question. I have a question on the discussion concerning the time lag of monetary policy decisions and the effect it will have on inflation, because you have, of course, tightened at a record pace now, and there are discussions that one first has to wait a little bit until to really see the materialization of those rate hikes. So how are discussions going on that front? And then I would like to know whether you have discussed accelerating the shrinking of your balance sheet, and if not, whether this could be a topic for the so-called second half of the year. Thank you.
Thank you very much for your 2 questions. I'll take the second one. We have not discussed the reduction of our balance sheets, and we have obviously acknowledged that the balance sheet has reduced, and it has reduced as a result of, number one, the reimbursement of more than what was expected to be reimbursed under the TLTRO reimbursement in June, and also by the fact that we have not only stopped net asset purchases, but we have stopped any reinvestment. So the balance sheet of the ECB is reducing as a result of that, but we have not discussed any further reduction at this point. On your other question, as you know, transmission of monetary policy is one of the 3 metrics that we use in order to determine our monetary policy stance, the strength of monetary policy transmission. And we look at it that way. We see it as essentially a 2-leg process. The first leg is transmission to financing at large. What is the impact on lending for banks, lending by banks to both corporates and households? And we try to measure that as accurately as possible by looking at volumes of loans, by looking at rates, by looking at, obviously, the bank lending survey that many of you have commented yesterday, which informs us about what banks anticipate and in which area and which directions they expect to either increase or reduce the volume of loans and reassess their risks in relation to borrowers. So that's the first leg. And there are clear indications that our monetary policy is transmitted through that channel. The next one, which is the second leg, is transmission to the economy. And from financing to the economy, how quickly does that move? How efficient is it? And we are really beginning to see now transmission materializing, whether you look at investment in housing, whether you look at investment altogether, there is obviously a decline on those two accounts. Still too early, and there is certainly more in the pipeline, but we are definitely seeing monetary policy being transmitted and being transmitted strongly. That's obviously the case for the first leg, and it is also now beginning to be the case in the second one.
Thank you, President. And the next question goes to Francesco Canepa of Reuters. Francesco, please.
Good afternoon. So at the last meeting, you said that you were not even thinking about pausing. Would you repeat that today? The second question is, would you agree with a line that's been repeated by many of your colleagues on the Governing Council, that the risk of doing too little outweigh the risks of doing too much in terms of rate hikes?
Well, Mr. Canepa, you'll have to understand something, which is that I'm not repeating things if prompted. I decide to say what I want to say, okay? So what I just said in response to the first question, I hope was clear, but I'm going to repeat it for you just to make sure that I'm as clear as you would expect. We are moving to a stage where we are going to be data dependent. And we will take the new projection by staff. We're going to take 2 new readings. We're going to take more information about how transmission is taking place. And on the basis of that, we will determine whether we hike or whether we pause. What I can assure you of is that we are not going to cut. That is a definite no. But on the other side, could be a hike, could be a pause. And if it is a pause, it would not necessarily be for an extended period of time, because as I said, it will vary from meeting to meeting, because we continue to decide on a meeting-by-meeting basis, every time informed by the data. All right? I hope it is as clear as I can be, because we are, and that was absolutely endorsed by the Governing Council, which has validated this decision unanimously. We are determined to operate on that basis. Voila. Your second question, I've forgotten. You always ask something that I should repeat or that I should endorse, but I'm not doing that, sorry. You know, if my colleagues take this view or the other, that's fine, and they can certainly be free to expand in one way or the other, but I can assure you that on the occasion of today, it was a unanimous determination. And the determination is rooted in one very simple direction, 2%. We want to break the back of inflation. 2% is the goal, and we will get there, come what may.
Thank you. Now turning to WebEx, I'd like to give the floor to Fabrizio Goria of La Stampa. Fabrizio, please, over to you.
Thank you, Wolfgang, and thank you for Madame Lagarde for this opportunity. I have 2 questions. Actually, one is on the financial stability. Do you consider the European commercial real estate as a matter of concern? And the second one, can you elaborate more in details the spiral between wages and prices? Thank you. Thank you a lot.
What? I'm sorry, the second question, you say the spiraling?
Can you elaborate more in details the dynamics about wages and and prices and inflation, basically.
Okay, so the risk of second round effect.
Thank you. Yeah, that's correct. Thank you.
Take the first one.
So, good afternoon. With respect to commercial real estate, it is quite clear if you look at our financial stability review that we have paid a lot of attention to commercial property and to the declines in prices. This decline in prices started even before the tightening of monetary policy. And, the different agents and players that are exposed to commercial property that are mainly non-banks. So it's something that we pay attention to, that we have analyzed in the past. And there is a clear, let's say, divide between commercial property and residential property. In the case of residential property, we have not seen any decline in prices. What we have seen is a slowdown in the evolution of prices. But commercial property is something that we have paid attention and that we will continue paying attention in the future.
And on your second question, I think you raised the question of potential risk of second round effect. Let me just take you back for a second, because it's a matter that we have reviewed, that staff is doing a lot of work on, and that we have discussed. It's the role of wage growth and the role of profit margins as two key drivers of inflation, which are gradually eliminating the external causes that were prevalent before. The wage increases is definitely playing an increasing role as a driver of inflation. And so have profit margins. On the profit margins front, we are seeing a slight decline in the first quarter of 23. And as you may remember, our projection is also predicated on the fact that profit margins are wide enough to accommodate the squeeze that will be needed in order to allow for wage increases. But if we look at inflation expectations, if we look at how wages and profit margins are evolving, we are not seeing a second round effect result. And for the moment, at least, nothing suggests the risk of strengthening any second round effect. But we are really monitoring that very carefully, because as you know, service inflation is the sort of hard nut to crack in terms of inflation, given that on goods it's going down, energy is coming out and is negative. Clearly we're focusing on services that are labor intensive and that are also not as sensitive to interest rates. But we're looking at that very carefully, and we'll continue to look at that extremely carefully.
Thank you, Madame Lagarde. And the next question goes to Andres Stumpf of Expansion. Andres, please.
Thank you. Madam President, regarding the September meeting and the possibility of hiking or pausing, as of today, does the burden of the proof fall on an improvement of the inflation outlook, or would it be enough if the situation does not worsen? And the second question, if I may, Spanish headline inflation is now in line with the mandate, and the labor market is as hot as it has been for more than a decade. Is it something like you would like to see for the whole Eurozone, or is it necessary for the unemployment rate to go up for the ECB to stop hiking? Thank you very much.
Do you mind me asking you to repeat what you said about the unemployment rate in Spain?
No, it's at the lowest point for more than a decade.
Yeah.
And
including for young people, eh?
Yeah. I was just saying that if you would like to see that for the whole Eurozone, I mean, the inflation going to 2% and unemployment being low, or is it just not possible and the labor market has to cool down?
I'll start with that one, that your question about Spain, because it demonstrates the beauty of Europe and the heterogeneity that we have amongst the 20 countries that are members of the euro area. Obviously, the numbers that we see now for Spain, with inflation trending towards 2% and hopefully sustainably so, plus unemployment numbers that are as low as they have ever been is a good set of numbers for the country and for the economy at large. It is not the same in all member states, and there are member states where inflation is still very high and has been high and is expected to remain high for longer. So we have to be very attentive to the aggregate number. Those are the ones that are driving our inflation outlook, that are helping us determine our policy. But we also have to look at each member state and the characteristics of each member state. We shall see. Data will actually inform us better, but the hope that we have is that inflation will come down to 2% medium term. That is our primary mandate. As you know, we don't have a dual mandate, unlike the Fed, and that's what is going to drive our determination. If we can do that with unemployment at the lowest level and staying there, that would be very, very, very good. It's funny because you ask the question of a lawyer. The issue of the burden of proof is very often a lawyer's issue. I think the burden of proof is going to be on the data, because we are determined to bring inflation back to target, but we are also going to be in the hands of data and the assessment of data. So the burden of proof is going to be on data.
Thank you. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Thank you. Madame Lagarde, two questions for you. First of all, how much do you think tighter monetary policy is contributing to the weakness in the Eurozone economy that you identified? And secondly, what would it take in terms of reduction in your growth forecast and a reduction in your inflation forecast in September for you to pause interest rate rises? Thank you.
Thank you very much, Martin. What we are working on and what staff is trying to be as detailed, specific, and conclusive about is the impact of our monetary policy on inflation. So this is really what is the focus and what is driving us. What impact our interest rate hikes have produce, and will produce on inflation. And obviously the exercise of producing the inflation outlook that will be conducted in September by ECB staff will be very informative for the Governing Council to determine how much has been transmitted and what is expected to continue to be transmitted. As I said earlier on to Annette, in the financing leg, a lot has been transmitted, a lot, we know that. In the economy at large, not as much yet. And your second question is totally hypothetical, and I understand, you know, why you would want me to answer that question. But there are so many data and so much to take on in terms of the projection that will be produced in September that I cannot answer your question in advance. We will really have to see.
Thank you. And next question goes to Jean-Philippe Lacour of Agence France-Presse, AFP. Jean-Philippe, please.
Bonjour, Madame la Présidente.
Bonjour.
Yeah, you are suggesting a possible pause in rates, je pèse mes mots, in the near future. Does that mean that during this period of possible pause, we could see an acceleration of the QT? And then it would be like a trade-off among doves and hawks at the Governing Council.
Thank you very much, Mr. Lacour. Our key tool, our key instrument in the current circumstances, given the level of inflation that we have at the moment, is interest rates. So there will be no trade-off between either interest rate or QT. Interest rate is the main tool and the most efficient one. So it's the one that we will be using. There is the possibility of a hike. There is the possibility of a pause. It's a decisive maybe, but don't expect me to go one way or the other. As I said, the burden of proof is going to be the data. And the ultimate point that we are determined to reach is the 2% inflation.
Thank you. Next question goes to Jan Malin of Handelsblatt. Jan, please.
Thank you. Good afternoon, Madame Lagarde. You've mentioned that several economic indicators recently have been weaker than expected, and there's some economists warning already that the ECB is overdoing it with rate hikes. So, and they think that more patience would be necessary. So what's your response on that? And my second question, climate activists criticize that green bond purchases of the ECB under the new scoring system have largely stopped. Have you perhaps promised too much in terms of what the ECB can contribute to climate protection? Thank you.
So we would be doing too much and promising too much. Look, doing too much is certainly not something that we are considering. What we are focusing on is the inflation numbers. We are committed to deliver 2% headline medium term on a sustainable basis in a timely manner. This is our commitment. This is the drive of the Governing Council. When I look at headline numbers, when I look at core inflation number, when I look at all the many measures of underlying inflation, trying to really isolate the most robust element and removing the most volatile part of it, we are seeing inflation that is still too high and that we project to remain too high for too long. So we have to do what we have to do, which is currently to hike. We know that we are getting closer, but we also know that the options are on the table to continue to hike or to hold. And we also know that it will vary meeting by meeting because we want to be determined by the data and the analysis and the assessment that we make of the data. It's not surprising that it is transmitting to the financing channel. It is not surprising that there is less investment in housing. It is not surprising that there is less investment altogether. This is the intended impact of the monetary policy stance that we have determined. And this is precisely what will return inflation to target. On the other point, have we promised too much? We have promised in our strategy review and subsequent decision, we have promised to be Paris Agreement aligned. And obviously, as noticed by all of you and as noticed by Greenpeace as well, we stopped any asset purchases under the asset purchase program because we are no longer reinvesting. So as a result of that, under the CSPP, we are not reinvesting. We are letting that portfolio into runoff mode. What we have decided is that we will stick to our commitment to be Paris Agreement aligned. And we will, in the course of 23, elaborate the means and the ways by which we will be Paris aligned. I just want to remind you, and this is not to distract me for a second from the fight against inflation, but I just want to call your attention to the massive amount of work that is being done in the supervision arm of the ECB in order to really raise the level of awareness and the level of concern by banks and through banks by their clients. And this is really beginning to work.
Thank you. Turning back to WebEx, I'd like to give the floor to Tom Fairless of the Wall Street Journal. Tom, please.
Hi, thanks so much for taking my question, Madame Lagarde. You say that the burden of proof is in the data for future decisions. What data is it that gives you more confidence that you may be able to pause? And what data will you be looking at, especially over the next months, that would stop those rate hikes? Is it core inflation? Is it more that you're looking at the downturn in the Eurozone economy and concerns about that? And my second question is about the US and the comparison with the Eurozone. The US has raised rates significantly more than the ECB for a similar core inflation rate, or even the Eurozone core inflation rate is slightly higher. The IMF, your former employer, said this week that the ECB might have more ground to cover. Do you agree? Do you think that there is a suggestion that there might be more work to do in raising rates? Thanks.
Thank you, Mr. Fairness, for your two questions. What data will be important? All data. And obviously, we will be looking at all inflation data. Starting with headline, we will have 2 readings before our next September Monetary Policy Governing Council. We will look at core inflation, but we will go deeper into underlying inflation numbers to really appreciate and understand what is moving and what is steadily, sustainably moving. We know that some indicators are showing, particularly in the in goods, it's pretty obvious. You look at producer prices, it's pretty obvious. But when you start looking into services in particular, you have to really dissect those that are energy intensive, those that are interest intensive, those that are, interest sensitive, what share of labor there is in various segments of services. So we have to look into all that to understand whether the action that we have determined in the last year and a half now is really having a long-standing impact that will take inflation back to 2%. Don't forget also that we will be looking at the inflation outlook that will be produced by the ECB, which will give us, again, the expected path of inflation, and the readings for 24 and 25 will obviously be very informative for us. We will look at labor numbers, we will look at investment numbers, we will look at just every single parameter of the whole economy of the euro area that we can look at in order to inform ourselves. I know it would be helpful for those who are using the same models, that are playing the same exercise, to understand from us that there is one particular specific indicator, one particular set of data that prevails over the other. No, it is not the case. We're looking at all of it, and expectations are part of the picture as well. The institution that I used to lead, the IMF, has updated its WEO April numbers. And I don't think that any of its terribly talented staff would argue with me that inflation in the United States and inflation in Europe are two different beasts that are fueled by different drivers, and in a context that is vastly different, both in terms of fiscal, in terms of labor market, in terms of energy. And that certainly has something to do with explaining why figures are where they are. And you know that better than anyone else. The Fed started a little bit earlier than the ECB, and started from a base which was not negative interest rates either.
And the next question goes to Isabella Bufacchi of Il Sole.
Oh no, I wanted to add for Tom. You asked, do we have more ground to cover? At this point in time, I wouldn't say so, because as I said, the data that we just discussed and the assessment of data will actually tell us whether and how much ground we have to cover in September and at subsequent meetings. And as I said in the early part of this press conference, it may vary from one month to the other. Thank you.
Isabella, please.
Sorry.
Good afternoon, and thank you for the opportunity. President Lagarde, I have two questions. One is on this message that you're conveying of the next meeting, that it could be a hike or a pause.
Your next meetings with the
next meetings. And so, I mean, compared to what we had up to now, that is 25 basis point hike coming to the next meeting, well, do you have a message to the European citizens that the fight against inflation, you are getting closer to break the back of inflation? I mean, there is some good news in this announcement or these comments that you're making. And then the second question, if I may, is on your assessment of the ECB Euro area bank lending survey, because it had some data on demand that was, I think, never seen in the past 20 years. And so whether it was discussed at the Governing Council and it had an impact also on today's decision. Thank you.
Yeah, thank you so much. Yes, we are making progress. And I think the good news for European compatriots is that inflation is declining. You know, we had a reading of 10.6% in October. We are now at 5.5%. But is that enough? Is that good as a result? Not quite. We have a target, which is medium-term 2%, sustainable, and we want to get there. But I'm sure that, you know, people, when they do their shopping, when they fill up the tank, when they pay the gas bill, they see that the increase is not quite the same as 6-7 months ago. But are we satisfied? Are we claiming victory? No. We want to go to the end of the game. The bank lending survey. Yes, we looked at it carefully. It was debated with governors. And if you look at the monetary policy statement in the last, I think it's in the last paragraph that we have, it's very, very significantly described. We say the annual growth rate of lending continued to decrease in June, falling to 3% for firms and 1.7% for households, with annualized growth rate of 0%, completely flat, and minus 0.2% in the second quarter, respectively. So not only are we seeing it very mildly growth year on year, but we're seeing a decline in the last quarter, and the same holds for both corporates and households. So yes, of course, this is one of the elements of transmission that we have seen discussed, and the fall in demand is also obvious, particularly on the part of corporates. A bit less so for households, but on the part of corporates, absolutely. Absolutely. Yeah.
Thank you. And this brings our press conference to the end. We wish you a very nice and happy summer, and see you back here for our next press conference on the 14th of September. Thank you very much.
The ECB wrapping up the news conference, going into a long summer for President Lagarde and the Governing Council. The next stop, the September meeting. Welcome to the programme, live from New York City this morning. Good morning to you all. Let's work through the price action together on the S&P 500, about 7 or 8 minutes into the session, advancing by 0.8%. The ECB, rather like the Federal Reserve, attempted to retain what many people are calling maximum optionality. The ECB decided to hike interest rates by 25 basis points. Just on the next month, September, that decision could be a hike, could be a pause. At this point, I don't think there would be more ground to cover, but obviously that could change between this meeting and the next based on what data we get between now and then. One key determination for President Lagarde and the ECB to bring inflation back to target, to break the back of inflation, but ultimately we're not in the domain of providing forward guidance. Everything she said in that news conference sounding very similar to what we heard from Chairman Powell in the news conference yesterday after the Fed hiked rates. That's the equity market story. Let's turn to the bond market briefly and work through what's happening in Europe. In Germany, we see a rally. Yields lower by 8 or 9 basis points at the front end of the curve. Similar move over in Italy as well. And in the FX FX market at the moment, the euro, a bit weaker against the dollar. Euro-dollar breaking down in and around 110. 110.05 at the moment. We're negative by 0.7%. Here's the ECB chief weighing in on the inflation target.
On the occasion of today, it was a unanimous determination. And the determination is rooted in one very simple direction, 2%. We want to break the back of inflation. 2% is the goal, and we will get there, come what may.
We will get there, come what may. Over at the ECB in Frankfurt, Germany, at the European Central Bank headquarters, Maria Tadeo. Maria, what did you make of that?
Well, Jonathan, in the space of a month, remember, in June, we went from we're not debating a pause, we did not talk about that, to now switching to this is a central bank that keeps an open mind. It is data dependent, but has an open mind, and that means we could, in September, hike or actually go hold. She also said, don't ask me now which way this is going to go, because the burden of the proof, and remember she's a lawyer by training, would be on the data. Remember, there will be new projections in September. So we've switched to we're not contemplating a pause to maybe it's open-minded, keep an eye on the data. And the one definitive conclusion that we got from Christine Lagarde today was the one thing we're not even considering is a cut. So that is the entire 180 that we've seen in the space of a month.
It's not a pause, but it's starting to sound a little more like a pause. Maria Tadeo, thank you. I have to say, following the Fed, focused on the data, let's get to Mike McKee for the data. Bloomberg's Mike McKee joins us right now. Mike, in the last hour, going into that news conference, the data in America, pretty decent.
Absolutely, John. At least if you're looking forward to a soft landing, Christine Lagarde said the data will tell the ECB what to do. This is already telling the Fed it's going to have to revise its economic projections at the next meeting. GDP comes in at 2.4%. That is up from the first quarter's 2%, and it is much stronger than the 1.8% that had been forecast by economists. It did match the Atlanta Fed's GDP now, so congratulations to the folks down at the Atlanta Fed. Personal consumption a bit weak, 1.6%, down from 4.2% in the first quarter, but business spending way up, 7.7% for non-residential fixed investment. Residential investment not as strong as you'd hope, but if the real estate market comes back, that would help out a lot as well. Durable goods orders, 4.7%. Most of that, Boeing, a 69% increase in aircraft orders, but basically there's also strength across the board. Businesses are still investing money. And then, of course, every month, John, we watch the jobless claims numbers, and yet again they drop. 221,000, down from 228,000 the week before. And the number of people who are continuing to get benefits, people who are actually receiving a check, 1,690,000, down from 1,749,000, almost 100,000 fewer people on the jobless rolls. We also got advanced trade, which showed a narrowing to $87.8 billion. So overall, good news pretty much across the board for the economy is still growing. People still have jobs. Now the question is, what is the Fed going to do about its projection that the economy would only grow 1% this year and that unemployment would rise to 4.1%? Both of those numbers in jeopardy.
Yeah, that doesn't look like that's going to happen anytime soon. Mike, just to work through the headlines we got from Chairman Powell yesterday, just on policy being sufficiently restrictive, the FOMC believes monetary policy is restrictive, just not restrictive enough for long enough. Now, Mike, based on the data we've had so far, can you point to the evidence that policy is restrictive enough?
Well, I think we got to wait till tomorrow, John, because we'll see the PCE inflation numbers. When you look at the CPI numbers, they came in significantly lower, as Jay Powell acknowledged. And the Fed wants to see it in their favorite indicator, PCE. We'll get that for June tomorrow. And if we see that kind of progress, then you could argue that maybe it is restrictive enough at this point and just has to be maintained. And, of course, the Fed going to be looking at 2 more CPI reports, another PCE report before their next meeting.
Data pretty decent. An hour and 15 minutes ago. Mike McKee, thank you. The economic data out of America, pretty strong this morning. Upside surprise, the right kind of downside surprise on jobless claims again. Yields higher, On the Treasury curve, the 2-year up by 3 basis points to about 4.88 on a 10-year this morning, yields up by 3 basis points or so. To turn to the equity market, about 13 or 14 minutes into the session, advancing by 0.8% on the S&P, outperformance on the Nasdaq, outperformance on Meta, getting it done after the close yesterday with earnings. The stock is higher this morning by 8%. Abby has more. Morning, Abby.
Good morning, John. And a very impressive quarter, and more so the outlook. But the quarter that they just reported, they beat both top and bottom line estimates by about 3%. Very impressive is the fact that their revenue growth turned to double digits. Analysts were looking for high single digits, but the growth for revenue grew by 11%. And that's the same deal, even better for the quarter that is right now. Now they are looking for revenue growth of roughly 20% in the third quarter. So that's almost a doubling of what we just had, and they're driven by 34% expansion impressions for the quarter that was, and along with the recovery that they've seen in ad sales. They're really just putting it all together. This was the year of efficiency, so it was going to be cost cutting, but now we're actually seeing this top line growth. The stock right now, John, up 168% on the year, but interestingly, its price to earnings ratio just 21 times, below the mean of the group around 29 times. So when you put that together with that revenue growth, if they deliver, there is an if there, but that is the expectation, you have the stock heading to its best day since late April, up for a third day in a row.
What a rip-roaring rally, Abby. Widely unexpected, massive outperformance so far this year. One of the best performing stocks on the S&P 500 through March of 2023. As things stand, the highest since February of last year, February 2022. That stock up this morning by 7.8%. Let's get to the panel. Academy's Peter Chip, Winnie Caesar of Credit Sites. Winnie, I think we put the ECB to one side. We get straight to the Federal Reserve and the economic data from 8:30 Eastern. Winnie, from your perspective, what signs do you see? What evidence do you see that policy is sufficiently restrictive?
Well, I think that the sufficiently restrictive is very much contingent upon real positive yields. I mean, that's a pretty significant point that Powell made during the press conference yesterday, and also much more encouraging from a policy standpoint. Now, a lot of the other data is definitely not supporting the restrictive, but we can't forget just how brutal last year was. We had an awful lot of transition, a lot of headwinds in different parts of the economy, markets down significantly, volatility up much higher. So given how much transparency there has been in talking about policy, talking about where policy is going to go, it doesn't surprise me that a lot of the moves have already played out, and now we're at this kind of lull of a bit more of a Goldilocks scenario.
Pete, are we in the sweet spot, and how long can it last?
Well, I think we can at least focus on earnings, the economic data. The Fed and even the ECB, I think they're going to take a back seat, right? They have very high hurdles to act. They're going to need to see data consistently high or consistently low to do anything. So I think every big macro data point is going to be less important than it was. That should reduce volatility, let people focus on earnings. And today I think it's really exciting that stocks are up, not because of the dovish Fed yesterday, because Meta really delivered. So I think that's what we have to look for is what's the economy going to look like longer term, and how are earnings coming in?
You published as that news conference was ongoing. You wrote exactly what you've just said. Central banks taking a back seat. You then wrote this. Both are really seriously, honest to goodness, data dependent, referring to the ECB and the Federal Reserve. Pete, how data dependent? And between now and September, what data are they dependent on?
I think that's going to be the neat part, right? Up until recently, they say they're data dependent, but they were looking to either have an excuse to hike or do something. I think they're going to truly analyze this, and they're going to look at 2 months worth of data and see where the preponderance of evidence comes in, you know, as she's a lawyer. But that's what you're going to start seeing is every data point is going to be less important. They're going to look at inflation. They're going to look at jobs. They're going to look at growth. And I think that comes in. I think it's actually going to be steady and maybe slightly declining, which I think is going to turn the Fed at least to the dovish side of things, but not this year. That's a next year story.
So, Winnie, let's put some money to work. How much risk appetite have you got right now?
So we have been actually notching down our risk appetite a bit, and that's not because we are all of a sudden bearish on the outlook, but we think that the compression trade in corporate credit has really played out. We are now tight of our U.S. high yield targets. We're pretty much on top of our U.S. investment grade targets for the end of the year. And these were pretty bullish calls just 6 months ago. So we've come a long way really fast. And we like credit for the carry side of things again. In the European markets, we've been a little bit more cautious overall. Yields are lower there. The potential for a more stagflation-y type environment is definitely something that we've been a bit more concerned about. So we're kind of sitting in neutral almost across the board, waiting to see if the fall vol spike that generally tends to materialize actually comes to fruition this year.
The divergence is pretty interesting, Winnie. I'm pleased you touched on it. Pete, if you look at what's happening in Europe at the moment, growth is bad, inflation's still sticky. In the US, growth's still decent for now at least. Inflation decelerating, disinflation starting to take a hold. Do you see some divergence emerging here, Pete, between not the central banks, who sound the same in the last 24 hours, but their underlying economies?
I think the underlying economies are a little bit different. Europe's behind us. Europe still has to face a little bit more directly the impacts of the war in Ukraine. So I think they're going to be slower to respond. But over time, I think I'm starting again, what's lagging behind? And maybe Europe's the right place to be, right? If they are 6 months behind us in terms of where they are in their inflation fighting, in terms of what they have to do on the rate side of things, that could be an interesting opportunity. And I was agreeing with Winnie. We kind of like credit. And I started to scale back a little bit last week because, okay, we've had such a good run. But I think after the messaging we're getting, I think credit can go tighter. I think equities can go higher. I think it's going to be the laggards. But you really want to start picking, okay, what's run maybe too much? Obviously, Meta's doing phenomenally today, driving the NASDAQ 100. But I like the laggards. I'm kind of leaning back towards banking, commercial real estate, things I've been cutting my position on. I think we're in a nice little sweet spot for the next month or two.
Peter Chair, commercial real estate, really, is what a lot of people will be asking. Why?
You know, right after Silicon Valley Bank went under, I think 25 banks must have had emergency calls on how bad commercial real estate is. I think commercial real estate is going to struggle. I think it's going to be very regional, but you are starting to see some pressure to go back to the office, right? As more companies start kind of pressuring work from office, that helps a little bit. And these things take a long time to bleed out, even if there's going to be trouble. So I think people got too bearish. You look at how far down most of these indices are, or the stocks themselves are. I think there's opportunity for a nice little short squeeze still.
So, Pete, just to be clear, you mentioned a time horizon. We're talking about a 1 month sweet spot. Is that worth the squeeze?
I think it could be. In this sort of market in August, maybe we go 5–10% on some of those indices, maybe more, right? They're so underweight by so many people, it doesn't take much good news to squeeze those higher. And I think people are looking at the Metas and the quote-unquote Magnificent Seven, and they want to invest in them. But I think if you're going to plow more money to work at this stage, you're trying to plow it into the things that look like they have the most upside and have been most underweight.
You mentioned Meta up 8% right now, the NASDAQ up by 1.8%, Apple as well, looking pretty decent this morning. Close right here, and it's a record high for Apple. If we close at these levels, the stock year to date higher by 51%. When we're talking about both the equity market and credit risk here, but just for credit specifically, because that's what you can speak to, what do you think when you hear Peter talking about just the juice worth the squeeze through the next month and being in this sweet spot that you also alluded to?
I think it's a really interesting point, and one of the things that I hear quite frequently from our clients is they went into this year a bit underinvested. Cash balances are still too high, and that, I think, is the most bullish signal that you can kind of find across financial markets. I think this applies to credit. I think this applies to equities. There's been a massive rally across markets, and people still have too much cash. Now the cash drag is not nearly as severe as when, Fed funds is at zero. At least you can get paid a little something for your cash balances. But there definitely is that view that, uh-oh, I've missed out. I just need to hold my nose with this economic data being quite strong, with the Fed being probably near or at the end of its hiking cycle. I just need to just get back into this trade.
Winnie, thank you. Winnie Caesar, Peter Chair. Fascinating moment, transatlantic, the ECB versus the Fed. To the two of you, thank you. Thank you again. Just if you look at things at the last 24 hours or so, the Fed and the ECB sound exactly the same in many ways. But look at the economic data. The backdrop's pretty different. And I just wonder how that evolves in the bond market. Perhaps you get a little bit more divergence like the divergence we see on the screen this morning with the German two-year yield lower by 7 basis points and the US two-year yield higher by 4 basis points. Euro dollar backing away. We're down by 0.6% to about 110.12. Let's get you some sector price action. Abby, the rally continues.
It really does, John. The risk-on mood is here, and not surprisingly, as a result, most sectors are higher, led by communication services. That, of course, is Meta, up 3.4%. Right behind it, technology and then discretionary. Those are the three mega-cap tech sectors, the best on the year, all up more than 30 to 40%. Today, rallying, making the day more risk-on. Utilities on bottom. John, here I'm taking a risk, but we're seeing something that we have not seen ever, going back to the Dow's entire history since 1900. We are now up 14 days in a row, just for you, John.
The run continues. I appreciate it, Abby. Thank you. Your trading diary up next.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
This is Bloomberg.
"26 minutes into the session, the data's okay. The Fed's backing away a little bit. Sounds a bit more patient relative to what we heard last year, right? The tech earnings have been decent so far, Meta, Alphabet, and the equity market's doing well. We're up by 0.8%, and many guests are talking to us and saying, maybe we're in a sweet spot through the rest of this summer. We'll see. Let's get to the trading diary for the rest of this week. Intel, Ford, after the close. Rounding out the week with a BOJ rate decision tomorrow. More tech earnings next week. Qualcomm on Wednesday. Apple, Amazon this time next week. And finally, next Friday, it's payrolls from New York. That is it for me. Thank you for choosing Bloomberg TV. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. and you have to accept and own things you may not like. But the more you could be you, the happier you will be.
Moment news breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Matt Miller back in the studio with me. We're getting the band back together, folks. So let's talk cars. Why not? I don't think it's a coincidence. Monica Raymond, Autos Industry Disruption Reporter with Bloomberg News, joins us to talk earnings from Volkswagen and the outlook for other European makers as well. Plus, we're going to break down that ECB decision with Anika Gupta, Director of Macroeconomic Research at Wisdom Tree. So lots coming up. We got earnings. We got central bank stuff. We might even fit in Barry Ritholtz in the 12 o'clock hour if we're not careful. But first, let's kick things off with John Tucker and get a Bloomberg Business Flash.
All right, RAFTA data this morning, and that continues the theme, kind of like better than expected. Pending home sales month over month up 0.3%. The decline of 0.5% was expected. That's better than expected. Year over year, down 14.8%. Believe it or not, that's actually better than expected. Second quarter GDP figures, they were out earlier today. A very resilient economy showed their consumer spending came out much better than expected. If that's not all, jobless claims, they were lower than expected, indicating the labor market does remain strong in the U.S. Vince Reinhart, the chief economist at Mellon Investments, reacted to the numbers.
The main takeaway is tight labor market is fueling household income, and household income is supporting consumption. It's hard to get a recession that way.
Well, Meta leading the NASDAQ and the S&P 500 right now after reporting strong results for the second quarter. They also delivered a pretty good outlook for this current period. Then you have oil, West Texas, rising above $80 a barrel earlier for the first time since April. OPEC Plus curbs tightening global supplies there. S&P 500 right now 36 points higher. That's up 0.8%. We're at 4602 on the index. The Dow Jones Industrial Average up 74 points. That's up 0.2% right now. The NASDAQ 100 up 275 points. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Matt and Paul, where's he been?
Where did this come from? All right. Matt Miller, back
Obviously
in the studio here. I don't know where you've been for the last 6 months.
I've been subbing. So Tim Stenivek, who typically anchors Bloomberg Business Week with Carol Massar, he was away on paternity leave.
Okay.
And during that time, I was filling in for him. It was great fun. Carol's lovely.
John Tuck and I were worried that something happened to Matt, that maybe, the badge stopped working.
I wasn't really that worried.
No, I'm back and on a great day. I mean, there's so much news with the big Meta moves. That's pretty awesome. Plus, you've got all this banking regulation stuff going on. We just found out that the biggest banks are going to face a 19% boost in capital requirements. That's what they were scared of, but we kind of knew it was going to happen.
Yeah, but it's just like they were regulated after the great financial crisis. So you had a couple small banks with idiosyncratic problems, and now you're heaping more regulation on the banks. Jamie Dimon cannot be happy.
No, and I think a lot of regional bank lenders are not going to be happy because they're going to lower that bar to bring more of them into regulation. But, there's so much going on in the world of cars as well. I hope we can focus a little bit on that. Also, weed. Did you see what happened yesterday with MasterCard?
Yeah, that is not good for the weed world.
It's rough.
All right, let's get into the stocks here. There's a lot of movers out there. The S&P 500 up 0.75%. Let's see where the action is. Abigail Doolittle, Bloomberg Markets correspondent, joins us here in our Bloomberg Interactive Broker Studio. Abigail, what are you looking at?
Well, it has to be Meta and this tech rally, more precisely the communication telecom services sector up more than 3%. Meta right now up to 8.4%. Its best day since April 27th, up for a third day in a row. And of course, it has to do with this quarter. So the quarter they just reported, very strong. They beat estimates. Very important is the fact that the estimate that they were being modeled for was about 8% revenue growth. It came in at 11% growth. So they're now back to double-digit growth. The bigger story is for this quarter, analysts are expecting them to put up 20% growth. So basically a doubling of revenue growth. This year was supposed to be the year of efficiency, cutting jobs, becoming more efficient, cutting the amount of money that was going to go toward the metaverse. And now it's actually becoming also the year of revenue growth, ad sales strong, real strong, and AI helping out.
I think Mark Zuckerberg, you think about, a year and a half ago, how much pressure he was on from investors, regulators, industry peers for the handling of the company and the switch to the metaverse. I don't know. You kind of got to give him a big pat on the back here. You can take a victory lap on my mind because A, he delivered on the cost cuts and the stock reacted, and now they're getting back to some pretty good revenue growth.
Yeah, it's a real about face. I think that we talked about it before on this show that at least I was shocked when that announcement first came out in December of I think it was 2021 that they were letting go of the Facebook name and going to the metaverse and then all in. And obviously 2022 was a difficult year no matter what, but to be giving up your bread and butter. So all of a sudden to have this reversal, was it purely Mark Zuckerberg? Did he come under tremendous pressure from the board? It's unclear. But yes, the company definitely deserves many victory laps. It's a complete turnaround and they're going back to being a truly relevant mega cap tech name, whereas last year they were sort of falling out of favor. You wondered what was going to happen with Meta.
I heard from Mark Douglas earlier today, the guy that runs Mountain. He says there are two ad industries. One sells ads, the other sells outcomes. He says Google, Mountain, Meta, and other direct response performance platforms sell outcomes. No one goes to Google or Meta to buy an ad. They go to those companies to get targeted consumer traffic that will likely make purchases.
Huh, that's pretty interesting.
That's a good way to look at it.
Yeah.
That's a strong
I thought it was interesting. Nonetheless, they are spending, what's the forecast? Total expenses will be $88 to $91 billion this year.
That's pretty significant. Although wasn't that the annual budget for the metaverse alone before he decided to pare back on that? So I don't know. When you look at the revenue growth and earnings is pretty strong, it's pretty impressive. Now, all of this said, if you take a look at this year's rally, it is filled with gaps, which are basically, that's what's happening today, too. So if you put in the meta chart, you're going to see,
I see what you're saying. Okay.
that
Gap
it goes
up.
up, and then, there's a space, and it gaps up.
So that means the opening price is higher than yesterday's closing price.
Yes, and typically by 8% like today, or 10%. And basically, that tells you that investors were caught completely off guard. Nobody expected this, especially because the stock was up 150% into today. The thing about gaps, both to the upside and the downside, and you can look at the chart when it was going down in 2022, there was a ton of gaps there, too, because everybody was surprised that this company was sucking wind so badly.
There was one day that they lost $250 billion in market cap in one session.
Well, those gaps have now filled. So gaps filled. So the point I'm making is that those gaps to the upside at some point are very, very, very likely to fill, but it doesn't seem as soon as it could have prior to this report.
Another one that got earnings that got my attention. Like this summer, John Tucker and I, we stay on the Jersey Shore. We don't go anywhere. I don't get on a plane unless somebody's
Just to be
paying
clear,
me to get
it's
on the plane.
not together.
It's not together. But it's
the
the
odd
couple. Yeah, the odd couple. It's a very large area of the Jersey Shore. But MasterCard spending climbs as consumers book overseas travel. Everybody I know has been or is going to Europe this summer.
Yeah.
I've never seen anything like it.
Yeah.
And I guess the MasterCards, the Visas of the world, and the Amexes, they're seeing that in their results.
Are benefiting from that. Yeah, actually, I met somebody last night. He and his wife are going to Europe next week to go to Rome, Florence, and Paris.
Why is Barcelona the new, like, Paris?
Yeah,
Everybody I talk to is going to Barcelona, every age group.
Well, something we're actually going to be interviewing, I believe today, the CEO of Trinity Investments, and they are one of the biggest owners of single hotel properties. In any case, in the research for the interview, what I found out is Europe is hot, the U.S. is not. Now, the U.S. is still fine, but after basically 2 years of not being able to, 2 to 3 years of not being able to go abroad, the revenge travel spending that we saw back in 2021 and 2022 in the U.S., well, it's now going European.
I mean, I'm only back in this studio for 2 days.
Because?
I'm going to Valencia.
Valencia.
So it's 3 hours south of Barcelona by car.
Yeah, but you've got a reason.
Yeah, I have to drop off the wife and kid there.
Your wife is from Spain.
She's from Spain. That's right.
That's the point.
How is the paella in Barcelona? I've always wanted. I've
So
heard that
if you
look out
ask
in the
my
ocean.
wife or anybody from Valencia, they'll tell you that it's a mortal sin to order paella anywhere else besides Valencia.
Valencia. Okay, I'll
They
keep that in
insist
mind.
that you've got to use Valencian water to make it
Oh, so
authentic
it's like
paella.
sort of like the Philadelphia hoagie. You
Right.
can only have
Or the New
hoagie.
Jersey pork roll. You got to bring back the Jersey pork.
I'm not into that.
Doesn't sound very. I don't eat pork, so it doesn't sound very good.
To me, though, I don't love it because they leave all the bones and everything.
Oh, in there, so it's very.
They use rabbit, which is
But
delicious.
the bigger question is, did you tell your wife you don't love it?
No.
Yes.
No.
Okay.
Never.
Our
Anyone in the
secret.
fa-
Our
No.
secret.
Exactly. All right, Abigail, thank you so much. We appreciate it. Abigail Doolittle, markets reporter for Bloomberg News. You want to talk some cars, Matt? Some German cars?
I would love to, not just German cars. You're referring to the Volkswagen
Euros.
story.
Yeah.
They're made everywhere, right? And China is, I think, the real problem here.
All right, let's go to Monica Remuth, Autos Industry Disruption reporter. I didn't know we had a disruption reporter from Bloomberg News joins us here. So, Monica, let's start with Volkswagen. What's the news coming out of our good friends from Germany?
Thanks for having me, guys. I mean, the biggest news of the week, I would have to say, is the deal with Xpeng. Basically, Volkswagen came out yesterday and said that they're investing around $700 million in this EV producer in China, and it's really a first for Volkswagen. It's basically sort of them admitting, we can't really keep up on the Chinese market, so we need to partner with somebody who really has their finger on the pulse of what Chinese consumers want.
It's amazing because, I mean, Volkswagen is usually the biggest or the second biggest car maker in the world, right? How key is the Chinese market, Monica, to Volkswagen? And is it that important to other manufacturers?
Oh yeah, I mean, China is absolutely huge. I mean, it's basically like 30% of their revenues, and it has played a key role for them over the past several decades. And I mean, Volkswagen was really a star there, the market leader for the past decades, because they were banking on that German reputation of engineering ability and that cachet as a foreign automaker. But now, as the tide has turned and everyone's pivoting towards electric vehicles, the local automakers, the local startups in China are able to leverage what they're able to do when it comes to software and technology, and the consumers are pivoting that way. And Volkswagen has been really slow to sort of pivot in that direction, and they've really struggled on software, trying to.
Now, Herbert Diess was chased out as CEO, but I kept seeing headlines like spending $50 billion to build EVs, and I think Rahlwald wrote a story back in the day that Diess wanted to start a huge software company within Volkswagen, and he was spending almost $30 billion on that. What happened to all those efforts?
Oh, yeah. Oh, I mean, those efforts are still underway. The software unit, Cariad, is still alive and kicking, a bit barely. Not barely, I shouldn't say that, but all of those efforts, they haven't all been for naught. You know, Cariad, the software unit, is still creating two of the big coming platforms for Volkswagen, the two big EV platforms, one for the premium brands, Porsche and Audi, and then one sort of like a catch-all platform that can be tailored to across all of the 10 brands. The problem was Cariad, the software unit, just took on too many tasks at the same time, and they were overloaded, and they weren't able to deliver non-glitchy software, especially when it came to the ID series for Volkswagen. So basically, Bluma came in and he said, okay, hold up. We need to clean house a bit. We need to refocus our energies. And he's put in a new CEO at Cariad. He's created this 5-point plan of trying to get things in order. And he's also taken a page from the playbook of Porsche and sort of saying, listen, compared to my predecessor, I'm not afraid to go into third-party partnerships to get the best technology here. And he's really saying, yes, we will stick with our software strategy with Cariad. Yes, we will continue to deliver the platforms, the EV platforms for Audi, for their Q6, for the Porsche Macan. But also moving forward, we're not going to be afraid to partner with other people who have been doing this a little bit longer or have more expertise that we currently don't have.
So, Monica, just give us the kind of your sense of how the European automakers in general are pursuing this transition to EV. Is there a sense that they're on the cutting edge, or they're lagging? Kind of where are they?
Oh man, that's a really tough question. I mean, Volkswagen was sort of the first European car maker to jump in feet first into the EV push. I mean, that all came as a result of the diesel scandal, and they were sort of nudged a bit in that direction, right? But they've really been they've sort of started out. They were the first ones to move forward, and then you had Mercedes and BMW sort of moving forward on that. The difference, I think, there is you have Mercedes and BMW that are more in the premium and luxury market, right? And so they're able to, it's the same thing with Porsche. They're still able to leverage their ICE sales, their combustion engine sales, use that to fund partially this push into EVs.
Glorious
apparently,
machines.
Yes. Indeed.
Monica, are the other car makers as active in China? I remember seeing some stories about some of the Stellantis brands, pulling out. Now, maybe it just wasn't a big enough market for those individual brands, but surely Tavares has to be worried if it's this important to Bluma.
Yes, some car makers are more active in China than others. Stellantis, I think, you're right, has moved away from China and is focusing his efforts elsewhere. I think the concern for Tavares more is, what do the Chinese car makers mean for Europe when they come over here? Because the Chinese makers are focusing more on sort of these smaller vehicles that are maybe more affordable. And if the European car makers can't focus on that segment, there's a real fear among some analysts and automakers that the Chinese makers could capture a segment of the market that the European makers are not focusing on. And so that's why, there's this drumbeat, at least from Tavares, that we need to make these vehicles more affordable. We need to get regulations. We need to get, government policies on board in Europe to make these cars more affordable in Europe. But in terms of how other car makers are doing in China, I mean, it's really, Volkswagen was at the top of the list for a long time, but you have BYD that's really at the top now when it comes to EV sales, and then you have Tesla, who certainly can't be forgotten. And those are the two big players, at least to my mind.
All right, Monica, great stuff. Great catching up with you. Monica Raymunt, Autos Industry Disruption Reporter for Bloomberg News.
Joining us out of Berlin,
right in the middle
my old
of
office.
Your old beat, right?
Yeah.
Exactly right. Where's your car these days, your Challenger? Do we know where it is?
It is, supposedly it's scheduled for production in Canada.
Okay.
But they haven't sent me the actual production confirmation yet, so I'm still waiting. And in the meantime, I'm looking across like Auto Trader, and maybe I'm thinking maybe I should go for bright orange instead of dark green. I'm not sure.
Really?
Yeah.
Oh, so you haven't selected even that yet. All right. supply chain still an issue in the auto industry. Matt's been waiting for this Challenger with the Scat Pack
all year long
for like a year. I don't know what's going on there. All right, we're gonna have more coming up. This is Bloomberg. Good morning. Let's get some company news right now with Lisa Mateo.
Good morning. Meta Platforms revenue growth is recovering big time now. Costs are under control, and Reels, those are those short form videos like the ones you see on TikTok. They've drawn more attention to Instagram and Facebook, and it's really helping pull in advertisers. Bloomberg Intelligence Mandeep Singh spoke with Bloomberg Surveillance.
Cost control is the primary driver of why the stock has run up so much, because the margins are trending in the right direction. But with inflation pulling back, it's good for ad spending. And that's what we saw that, from Alphabet. I think Meta was no exception.
Now, just to give you an idea of how much that stock has been affected, nearly 18 months ago, Meta set the record for the biggest market value wipeout in stock market history. Now, shares of Meta now are up about 8%. And your bill might be going up if you're an AT&T customer. Bloomberg's Kimberly Adams has the story.
The company is raising the cost of its unlimited elite wireless mobile plan next month by another $2.50 a month. It's the second rate hike in 2 years. That increase coming as subscriber growth slowed in the second quarter, more than Wall Street expected.
Now, shares of AT&T right now down just a fraction. And Tesla owners who aren't as impressed with Elon Musk, but they sure love their Model 3s. That's according to a Bloomberg survey of thousands of owners who together had put 100 million miles on their EVs. Now, out of dozens of questions asked that were repeated from a 2019 survey, the biggest change in opinion was the drop in Musk's approval. But most owners, they say they still plan to stick with the brand anyway. And checking in with some Tesla stock right now, Tesla stock up just about 0.5%. Those are the company stories we're following this hour. I'm Lisa Mateo.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. You know, just 3 months ago, forecasters were predicting almost zero growth in the U.S. This morning, we learned gross domestic product rose at a 2.4% annual rate, and the Fed's preferred underlying inflation metric, that advanced at a slower than expected pace. The idea of a soft landing that is helping push stocks higher right now. You have the S&P 500 up about 30 points. That's a rise of 0.7% at 45.96. The Dow Jones Industrial Average 43 points higher. That's up 0.1%. The Nasdaq 100 230 points higher. That is a rise of 1.5%. Of course, Meta helping the picture there. BMW and Mercedes have each several hundred cars among the cargo aboard the Fremantle Highway. That's the ship that caught fire off the coast of the Netherlands, still burning in a fire that killed one crew member last year when a cargo ship that caught fire in the Atlantic, that was transporting roughly 4,000 Volkswagen vehicles to the U.S. It was just a few weeks ago that
Newark, New Jersey.
of those gigantic car carriers caught fire at Port Newark Elizabeth, and 2 Newark firefighters were killed.
Yeah.
So you talk about supply chain problems with car delivery. You got to ask the question, what is going on with those car carrier ships?
I think it's the batteries.
Yeah, I think
EVs.
we don't know, so we're just speculating.
Right.
But that was my first thought as well. My first thought is it's the battery, because otherwise you could easily extinguish a fire, but electric cars famously burn for days.
Yeah, it's an amazing story. Anyway, that is your Bloomberg Business Flash. We up to the markets all day long, right here on Bloomberg Radio. I'm John Tucker. Matt and Paul.
Absolutely. John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney here in our Bloomberg Interactive Broker studio. And I forgot to mention, we are simulcasting on YouTube.
So people see me.
So people can see that Matt's actually here. He's back after a little hiatus in the afternoon. So you can check us out on YouTube. Just search Bloomberg Global News. All right, this has been, in addition to just a week of, I think, 165 of the S&P 500 companies reporting earnings next week, and I think 172 next week. So super busy in the earnings season. But we've had a lot of central bank movement over the past couple of days, including the Fed yesterday and the European Central Bank today. So let's kind of break it all down and see where we are. Anika Gupta joins us. She is the Director of Macroeconomic Research, Equities and Commodities for Wisdom Tree. She joins us via Zoom. So, Anika, boy, what do you make of kind of what we've seen coming out of these central banks over the past 24 hours?
Yeah, it's been really interesting, Paul. You know, at one hand, we have both of these central banks, be it the Fed as well as the ECB, you know, keeping their optionality open. I think they've tried to, you know, indicate that they have covered quite a bit of ground on the inflation front. The only difference between the Fed and the ECB is the Fed is facing an economy which is a lot more resilient and stronger based on the consumer strength, whereas in the Eurozone, the ECB is faced with a situation where they have made a lot of progress on inflation,